Hello, this is session 1, and this is all about chapter 15, leases. You will hear the word leases, and we need to understand what is the implication of having a lease agreement between two parties or two sides, the lessee and the lessor. The accounting for the lease that will take the two sides. So normally is a contractual agreement between the lessor. The lessor is normally the owner of the property or the assets, and the lessee is the user of the right of using the assets. What the lessor gives the lessee is the right to use that assets, equipment, you know, or any part that they transfer for the usage, a land or store, even an airplane, anything could be leased nowadays, a car. So the lessor give the right to the lessee to use their assets, and in return, the lessee will pay periodic cash payments to the lessor. So the contractual agreement will have some accounting go to the lessor's side, we have some accounting go to the lessee's side. And if you know if someone is given and someone is getting, so it's kind of like the opposite relationships between the two of them. When you see one will have the receivable, one will have the payable. It's the kind of the opposite relationship between the two of them in terms of their accounting. The question will come, so why we lease these properties or equipment? Why we lease them? Why not to buy them? If you have the cash and the item is available for the sale, you probably will be able to buy it. But why we lease? This is from operational, financial, and tax incentive that often make the lease attractive other than purchasing the item is just to lease it. Let's say you have an item that you want to lease it and is subject to technology, and today is computers. You will get them today as a company, you buy them, but a year from now you want to update the whole system again. So why not leasing things like that, and in the future you will be able to upgrade and get rid of the items that you leased with probably a better terms for the next time. So the advantage of the leasing is to reduce the upfront cash. You don't have to pay for cash flow, right? To maintain your cash. So you probably can borrow money, and you probably don't need to put a cash upfront. So that's a good saving. Lease payment often lower than an installment of uh, that lower the payments, and leasing offers flexibilities because when you have these installments you will be able to adjust your payment if it's needed to be adjusted, and it's always going to give you probably a lower cost when you want to get rid of the assets. um, Leasing might give you some protection against the risk of declining of the value of the assets, because today has a value and maybe because of the inflation it might go down or it might go up, and it really depends on the item that you are leasing. And you probably going to have some tax advantages due to the fact that you're going to depreciate the assets if you get the assets and buy them, and then you recorded the depreciation against the assets, and sometimes you get tax saving for that. So here are the items that really technically you need to start to learn. So what types of leases we have? So okay, I'm gonna save the cash and I'm not gonna put the cash up front. Maybe I'm gonna borrow. Maybe I get some sort of lease advantages that I can lease the assets and then finance the asset through the companies that who's giving me the item instead of going to the bank and borrow the money and get the assets, purchase it. So for accounting purposes, we can report these leases in different shapes and formats. So the first type of the lease that we need to cover is, but we're gonna look at it from two different perspectives. So it's actually, if I may divide these into two sides, I would see that there is the relationship between the lessee and the lessor. If I have an asset that I classified under the lease as a finance type of lease, is the same type from the lessor. Remember, it's like the other side of the coin, but we're not talking about it as I'm financing the lease for you. It's a sale for me. I'm selling that assets for you. It's either when I sell the assets either with profit or without profit. So that's also gonna cover that sales type of a lease. But if the lease is classified as an operating from the lessee side, will be also classified as an operating lease from the lessor side. So with that, I can break it down as well into here. It's either the top portion, it's finance sale type. Remember, we have two sides to the stories. So it's a finance from the lessee, it's a sale type from the lessor. If it's an operating from the lessee, it's an operating from the lessor. And we're gonna learn what are the criteria that will make the lease a finance, an operating. But I'm gonna start from the lessee side so you get to see how is the lease look like. So we're starting with the finance type of lease. What are the criteria that will be there in the lease agreement? You're reading really an agreement, and sometimes they put provisions in the lease that you have to understand with all these provisions what makes a lease a finance versus a sale type of lease. So the lease normally will be considered a finance from the lessee's perspective versus a lessor, would we call it the sale type of lease, if it meets one or more. So here are the keywords that we need to focus on. Meets one or more of actually how many criterias? Five criterias. Do I have to meet all of them? No, only one or more. So if I give you five criteria in the lease agreement, when you read, if one of them is there, automatically you will take the lease criteria to make it classified as a finance type of lease. First one, the agreement is specified that the ownership of the assets transferred to the lessee. What does that mean? This is a very simple application to it. In the lease agreement, they will write down the lessee has the right to own the asset at the end of the lease term. So we can envision there is a lease agreement between lessee and lessor, and in the agreement, the lessor give the right to the lessee to own the assets, transfer the asset to them when the lease ended. Very simple. I don't need to do any calculation for that. This is just the wording in the agreement says I will transfer the assets from the lessor to the lessee. Simple. Number two, the agreement, which is the lease agreement, contains a purchase option that the lessee is reasonably certain to exercise bargain purchase option. Didn't get any of the words what they mean by that. What they meant to by that when they write the lease term, the lessor will offer the item, the property, the assets to the lessee to buy it at a lower value than the fair value of the assets. It's a bargain. That's why they call it bargain purchase. Oh, so I can lease the asset to the lessee, and I'm the lessor now, and I'm offering it to you to buy it at the end of the lease term. But the way to make it really a bargain, there is some certainties about that lease agreement that you're reasonably certain that if I'm going to put that clause or that caveat in the lease agreement, it will entice the lessee to purchase really the assets because the value of the assets is lower than the market value, which is great. That's why they consider it a bargain purchase option. The next criteria, the lease term is for the major part of the remaining economic life of the underlying assets. Again, let's explain what does that mean. Let's say I have an asset and I'm the lessor and I want to lease it. Let's say it's an equipment. The life of the equipment, the useful life of that equipment is 4 years. What considered to be a major part of the economic life of that asset. FASB came up, or GAAP came up with the value of 75% of the lease term is dedicated to the lease. Meaning, if I lease the asset, let's say for 1 year over that 4 years, so 1/4, that's 25%. That does not meet the 75%. I have to meet 75% at a minimum or more. But let's say I leased it for 2 years out of four. That's 50%. That does not meet the finance type of lease. What about if I leased it for 3 years over 4 years? So the 3 years is the lease term. The 4 years is the useful life. Sometimes we call the useful life the economic life of the asset, right? So the lease life or the lease term is 3 years, and the economic life or useful life, as we call it, is 4 years. That's 75%. No, that meets the criteria to be in a finance type of lease. So what I normally would do is here is a very simple calculation. I will have the lease term divided by the asset life. That sometimes we call it the useful life, sometimes we call it the economic life, they all the same. Okay? Then the present value of the lease payment equal or exceed substantially all of the fair value of the underlying assets. This item is really the most of the calculation that we're required to do for the lease classification. But what it says is if the substantially all of the fair value of the assets is really coming under the present value, meaning when I take the assets from the lessee takes the assets from the lessor, I'm going to have a periodic payment. Remember, I'm going to give them that periodic payment all the time on an installment basis. So if I give these installments, probably I'm going to lease it, let's say, for 4 years out of the 4 years that I talked about. If I lease it for 4 years, I'm paying all these, but I have to calculate the value of the asset now for 4 years. So that's why I'm using the present value. They say if the present value of the lease payment that you're going to make equal or exceed substantially all. The all here is about 90%, substantially all. So if 90% or more of the present value of the payment is equal or greater to the fair value is the current market value of the assets. If what you're going to pay now for that payment of that lease equal or exceed 90% of the fair value, voila, you get yourself a finance type of lease. And we're going to see all the details about the calculation, but this is generally speaking, what are these criteria? And I'm going to break it down and simplify it for you even further. And then criteria number 5 is the underlying assets of such a specialized nature that is expected to have no alternative use to the lessor at the end of the lease term. Sometimes number 5, they said if the assets is really a specialized or not, does it have alternative use or not? If I don't have alternative use, so equipment, I cannot change the computer to any other use to be anything other than a computer, right? I'm not going to change it to any other thing. But there's other things that you can revise it, recycle it, and things that it change the nature of it. But some items that asset has a specialized nature that you cannot really change it, or it doesn't have any alternative use to it. So you get yourself a finance stabilist. Just remember that all these 5 items, you don't have to meet all of them. It's only one or more of these criteria. So most likely when you read the lease agreement or any questions, you will look for these criteria and you sort through the verbiage that you get in the questions, trying to making sure that you really understand these criteria. What make a lease a finance type of lease? What makes a lease a sale type of lease? What make a lease an operating lease? So to simplify it, I put that diagram for you. And I would say I'm gonna break it down into these 5 criteria. I'm gonna call it owns. Those are the first letter of everything, of every criteria that we just went over, and just try to make it simple for you. Once you take these criteria and you examine it for each question that you get, to make sure if it's really, if it satisfies these requests, voila, you get yourself a finance stabilist. So what is the O stands for? This is ownership transfer that I talked about. At the end of the lease term, which is written in the lease agreement before even the lease start, at the inception of the lease. When they write the agreement, they said, oh, the lessor give the right to the lessee to have a transfer of the ownership from the lessor to the lessee. Voila. Okay, so I got the O. It's just a wording in the agreement. The W is the bargain purchase option, remember, but it's written. It has to be written because we're trying to give the comfort. It has to be reasonably certain that they give the bargain also at the end of the lease term, telling you you have the right as a lessee to purchase the assets at a lower value than the fair market value. And here is the N, stands for the 90% rule. Remember when we said the presentive value of the lease equal or greater to the 90% to substantially all. So I translated into a simple term and I said, okay, I'll call it the 90% rule. And this abbreviation, the 90% rule, is the, here's the PVMLP. Of course, does not make any sense to you now, but I will explain it to you. This is the present value of the minimum lease payment. Present value of the minimum lease payment. Professor, would you gonna give us the calculation for the present value of the minimum lease payment? Absolutely. And we're gonna go over plenty of exercises and examples for order for you to learn how to calculate the present value of the minimum lease payment. That should be equal or greater to the 90% of the fair market value. As I mentioned before, this is the only percentage that probably will take you to an area that it will probably going to take you a little bit of time to calculate it. But I'm going to break it even further on the coming diagram to show you how to calculate it. The 75% rule, which we set the 75% or more of the asset's economic life is being committed in the lease term, and I give you that lease life or the lease term over the useful or economic life, as we call it, for the assets. This is very simple. As I said, you have equipment. We leased it for 4 years, but the useful life on the item or the equipment is also 4 years. So 4/4 equal 100%. That definitely meets the 75% or more. So this is the very easy one. This is has to be stated also as well. We might need to do some calculation when we come to the bargain purchase. This is would require the most, but it's really, really simple, and I will show you how to calculate it. 75%, it is a calculation, but again, it's like you take in the lease life or the lease term over the useful life of the assets. It's a simple calculation. As for the specialized, no alternative use to the asset. Again, this is just by verbiage, and for the most examples as you're going to go through, you will find that the O, the W, the N, the S is the most common and is really visible and displayed in the question, not so much about the specialized that you will see a lot. Now, I'm taking this present value of the minimum lease payment and I'm trying to break it down. What make the present value of the minimum lease payment? Because this is the area that you really need to start to calculate. So here is the 90% rule, and I'm going to take that 90% rule and I'm going to try to put it how I'm going to come up with the 90% rule. I'm going to put them in 3 buckets. In order for me to come up with the present value of the minimum lease payment, and I abbreviated to the PV, PV means present value, MLP is the minimum lease payment. So let's understand it before we go into the items. Every time we have a lease agreement, it gives the right to the lessee to use the assets that is leased from the lessor, right? The lessor gives the assets. The lessee use the assets and pay a periodic payment. So at a minimum, the lessee have to pay the lessor a minimum payment. the periodic payment, right? The rental payment. So if I leased an apartment, I'm gonna pay the payment for the apartment, so that's my rental payment. So at a minimum, I'm gonna pay that rental, or sometimes I call it periodic payment. That's one. That's one part of the payment. For the most part, at a minimum, you have to have that minimum rental payment. At a minimum, you have to have that payment, the rental payment. The second one is the guaranteed residual value, if any. So I want you to envision this. So at a minimum, you're going to pay the rental plus, we're going to put the plus a little bit here, plus here, and plus here. So I'm always going to pay my minimum rental payments, and I'm going to add to that, if any. See that? It says if any. What is a guaranteed residual value? When the lessor give the right to use the asset to the lessee, you are leasing something now, but because this item does not belong to you, you're not the owner. So if there's no transfer of ownership, that means you're gonna return the assets to the owner, which is the lessor. But if I'm returning the assets at the end of the lease term, sometimes the lessee will guarantee that the value on the assets that I'm giving it back to you, it still has a value. Call it residual value. But sometimes I guarantee that residual value, and sometimes I don't guarantee that residual value from the lessee's perspective. So if there is any guarantee that when I return the asset to the lessor, and I'm guaranteeing a residual value, if any, if that clause is in the agreement, I will add that amount. Remember, it has to be always present value. So the present value of the guarantee, the present value of the bargain purchase. If there is a bargain purchase, and you are certain that you're going to be using that bargain purchase, that it means that the lessee will be purchasing the asset from the lessor by the end of the lease term with a value that is lower than the fair value of the assets. If that happens, this is all doesn't not necessarily happening all at the same time, but if it happens, so the minimum is locked in, always going to be at a minimum. You're always going to pay that minimum. But those are the added item. If there is a guaranteed residual value, if any, if there's a bargain purchase, if any. And the last one, if there's any penalty required to extend or renew the lease. Sometimes you write a lease agreement, but they put that penalty caveat. It's like, you know what, or clause in there says, you know what, if you don't return the assets in that period, or you have to extend the lease for another year, or renewing the lease in another 2 years, if you don't do that, there is a penalty. It's like, okay, if there is a penalty required, and I don't see any questions that we have, will have that penalty item. But for the most part, you could have seen the guaranteed residual value or the bargain purchase, not that much about penalty. But in theory, if there is a penalty, again, with the present value, it will be added to the lease payment. So I would say at a minimum, I always have the rental payment. If there is any guaranteed residual value, if any, I will add it to the minimum. If there's a bargain purchase, if any, I will add it to the minimum rental payment. If I have penalty, if any, I'm also going to add that. You see, if any, if any, if any. If ever takes place, I add that to the minimum rental payment. But minimum rental payment is always locked in. So that's the first piece that I can call it minimum lease payment. The second bucket here, I have the non-lease components. And what are they? So if I'm taking a lease and I'm writing all the verbiage about the lease, sometimes I would require the lessee, or maybe even on the lessor side, to pay other than the rental payment. There's other payment, but those are non-lease components, such as insurance on equipment, taxation on the property, maintenance on that property. So uh, the lease agreement will dictate who is going to pay what, if the insurance is on the owner or is on the lessee or the lessor, the taxes and the maintenance. But the component, those components are not leased. But I have, if they ever happen and they talk about insurance, even I'm going to pay them as a lessee, I have to separate the lease rental payment and then the payment of the insurance and taxes. So I'm not, I'm going to pay it. So let's say I have a minimum rental payment of $50,000 and I have $5,000 for maintenance. So the total payment is $55,000. But I have to separate. I have to separate between what is the rental payment versus the these non-lease component. In the last third bucket is the discount rate. Remember, I'm talking about present value of minimum lease payment. So I figure out my rental payment. I figure out if there is any payment other than the lease payment, but they call them the lease component, non-lease component rather. And then what discount rate I should be using that? Like, okay, that's a present value. So there is a discount rate. In the lease world, there are two discount rates, one called implicit and one called incremental. Remember, I have two sides to the story. I have the lessor and I have the lessee. I have the implicit that always come from the lessor, and I can use it to come up with the present value if that discount rate is known. What is the implicit rate? I'm going to talk about it in a minute. But also from the lessee side, there is the incremental rate. So when I run my calculations for the lease payment, when I do the discount rate to come up with the present value, I have to know uh, what are the rate that I'm be using to come up with the present value, because they might be both. Let's say it's 10%, 10%, 10%. It might be 10%, 7%. It might be you're not knowing the incremental, might be not knowing the implicit. They might give you one rate. So which discount rate that you'll be using? Here is the rule. The rule of thumb is use the implicit rate from the lessor side if it's known. If it's not known to you as a lessee, use your incremental rate. Now, here, how we're going to differentiate and we know what is the implicit rate, what does it mean, and what is the incremental rate, what does it mean. The implicit rate, without reading the slide, the implicit rate is really the rate that the lessor has in mind what amount you should be paying as a lessee that at the end of the day will satisfy the lessor to have a rate of return on that asset. So I'm not leasing as a lessor, I'm not leasing my equipment or my properties for nothing. I need to have a rate of return. So that interest, if you call it, it's not really an interest, but the time value of money, that rate to calculate the present value is the rate that it will help the lessor to achieve the return on the asset. So I'm giving you, I'm telling you, oh yeah, you can pay me that amount with that rate. Normally, if I combine that payment with that rate, I will get what I needed to get out of that lease because I'm not leasing it for free. I need my periodic payment and return on their assets as well. So that's the rate of return that considered to be implicit. And it's always happened from the lessor side. And sometimes it's not known to the lessee. I don't know as a lessee, what's in your mind? What give you that good return? Is it a 10%? 8%? I don't know. But if it's known to you as the lessee, use that implicit rate. Okay. When the lessor's implicit rate is unknown, the lessee should use its own incremental borrowing rate. So now you're going to ask me, so what is the incremental rate? Incremental rate is the rate that the lessee will pay if you go out to the bank and you borrow the money, right, to purchase or to finance that property or that leased item. If you're going to go out and borrow that money, that's the borrowing rate. So the incremental is the borrowing rate from the lessee's side. The implicit rate is the desired rate to get the actual return on that assets. Okay? Now, I'm going to come back and visit that present value of the minimum lease payment because, as I told you, most of the calculation is involved around that 90% rule. But someone will stop me and say, wait a minute, Professor, why would I bother with the 90% rule if any of the criteria of the 5 criteria of the owns was satisfied? If the O happened, the ownership transfer, or the 75% or the written option, any of that could satisfy. Why would I bother? Actually, you're supposed to calculate it because, especially early in the lease accounting, you're supposed to learn how to calculate if any item is to be calculated. So the 75% rule is easy to apply, as we said, lease term over the asset term. But the 90% rule, the present, just to come up with the present value of the minimum lease payment, it's not really that hard. And I'm going to show you multiple examples how you calculate it, so it's really not that difficult. But the thing is, you have to put all the calculation for all these criterias, if it's applicable to calculate, in order for you to determine, because what if there's no ownership transfer? Then I'm going to test the next criteria and the next criteria in order for me to satisfy. If none of these criteria happen, I got myself what type of lease then? It will be an operating lease. So I'm first from the lessee side. I'm going to apply all the 5 criteria for the lease. And if one or more happens, voila, I get a finance lease. And if it doesn't happen and I got none of them, by default, it become operating lease. So, Professor, you said there is a periodic payment in order for me to calculate the present value of the minimum lease payment. So, how are you going to do it? That periodic payment, when I pay the payment from the lessee to the lessor, I normally pay them either in the beginning of each period. Maybe it's on an annual basis, quarterly basis, or semi-annual, whatever the basis that for the payment. If they say the payment gonna happen at the beginning of whatever the period that the base for the payment, you should use, remember, you're gonna use the discount rate and the tables to come up with the discount, the value of the money. If they say the periodic payment happened at the beginning, you need to use tables 6-5, and I'm gonna show you. I already posted all the tables on Blackboard under course document, so you would see it. So the beginning, you always use the present value of annuity 2. What if they say the periodic payment happened at the ending of the period? Use the present value of ordinary annuity, table 6-4. So, Professor, where we locate those? I'm going to show it to you actually on the tables. And then finally, the bargain or the guaranteed residual value, if you have in the payment. Remember, we said if any. If they give you a bargain or guarantee, you should get the present value from table 6-2. So now let me stop here for just a minute and to show you the tables that I'm referring to and how to search the tables if you need to. So here are the tables. As I said, they are posted on Blackboard and they are posted under course documents. You will see the tables. So if I ask you if the payment happened, we said at the beginning, we said we're going to use table 6-5. See, this is table 6-1. So I'm going to try to go and locate table 6-5. Just going to make it a little bit bigger so you get to see. So here are the table 6-5. What are these And what are these? Those are the periods. Are you going to pay in 1 year, 2 years, 3 years, 4 years, 5 years? At 2%, at 2.5%, at 3%, at 4%, at 5%, and 6%. So let's say, for discussion's sake, they said we're going to lease it for 5 years at 4% discount rate. So what is the value that you'll be using? You'll be using the 4.62, and do not round it up, or so use the full 4.62990 to come up with the value of the present value. That's if you have the periodic payment at the beginning. So what if you have the periodic payment at the end? That means I'm going to use table 6-4. So I'm going to go here and use going backward. I'm just locating where is the 6-4. So this is 6-3. Let me move one more. So here is 6-4. So it's the same concept at 6-4, and this is ordinary annuity. So what was the first one? Was annuity due. This one is ordinary annuity. Remember in area. So this is the ordinary annuity. But if you pay in the beginning, the 6-5 was annuity due. Now here we pay at the end. So take another example. It's going to be probably, let's say for discussion's sake, let's say it's for 10 years lease life, and it's at 6%. So okay, here is the period and here is the discount, and you take intersect between the period and the discount. So if that happens, that would be 7.36009, and it could be any intersect between the period and the interest rate, okay, or the discount rate rather. Okay, well, what about if you have a bargain or guaranteed residual? You use the schedule 6-2. Got the idea? Okay, so I'm going to close the tables. As I said again, they are posted under course documents. Now we back to our slides. So we finished the periodic payment, how to come up with the present value. If it's the beginning, will be annuity due 6-5. If it's ending, will be ordinary annuity 6-4. And if it's a bargain or guarantee, those are the added item to the periodic payment, if any, and that would be 6-2. Okay. Now, there is an asset is going from the hands of the lessor to the hands of the lessee. There is depreciation that would take place. And I need to know who would depreciate and how you would depreciate it. If the lessee gets the assets and there's a transfer of ownership, right? Or there's a bargain purchase, you gonna hold that assets as a lessee, right? So how you gonna depreciate the asset? So the rule of thumb says you have the O, the N, the O, the W, the N, the S. Remember the owns, O, W, N, S. I used that mnemonic. I used that first letter of each word here. And I'm going to remind you where I used it. I'm going to go back one slide. I'm going to show you here is the O, the W, the N, the S. So I'm using the ownership transfer, the bargain purchase, written bargain purchase, 90% rule, 75% rule, or specialized. So what I'm coming here, I'm saying if the O or the W, the ownership transfer or the bargain purchase, I have to depreciate over the asset life. Asset life equal useful life equal economic life. They're all the same, but different names. Sam, Sammy, and Samuel. Same person, but different name. Asset life, useful life, economic life. Why would I use the asset life to depreciate it over? Remember, when we use a straight line basis, first of all, and you have the value of the assets over or the present value of the minimum lease payment over the asset life. The lease term could be same as the asset life. I could lease it for 4 years while the asset life is 4 years. I could lease it for 2 years while the asset life is 4 years. So you pick up the longer term because at the end of the day, if there is a transfer ownership, you become the owner as a lessee. So you better depreciate your assets over the asset life, really, because you're the owner. Written bargain, that means you're gonna you have the motivation, you're reasonably certain that you're gonna buy the assets at the end of the lease term. Then if it becomes yours and you the owner, then depreciate it again over the asset life. And it doesn't mean all of them going to happen at the same time. It's not going to transfer ownership and then you're going to return it back to the lessee. I'm sorry, the lessor. So it's either you're going to own the asset or you're going to return the asset at the end of the lease term to the lessor. So if you become the owner, depreciate it over the asset life. If the 90% rule or the 75% rule, then you depreciate over the lease life. So the lease life, as I said, could be same even as the asset life. I could lease it for 4 years and the asset life is for 4 years, but I could lease it for 1 year. So you have to learn all these rules in order for you to come up with the right answer. So in the ownership transfer is easy. Transfer that become an owner, asset life, that's the base for your depreciation. If there's a 90% rule or a 75% rule, then you use the lease life. And someone would tell me, so what if I found one or more, like one here on the written but one also on the 75, which base of the depreciation I'll be using? Whatever comes first. If the written bargain is written before the 70, take that asset life is more than the lease life. And I don't think that would happen that much, but technically it's going to be very straightforward the way that you need to depreciate the assets, either asset life or lease life. So let's take one of the exercises to understand. And um, when you get the book, you will find E here start in the beginning of the numbering questions. That means it's exercise. Sometimes there is the P, it's the problem, but E here stands for exercise. So in this exercise, it's all about lease classification. It tells you how you classify the lease. And remember, we said we're going to classify the lease as a, from the lessee side, it's either as a finance type of lease or operating lease. How you classify it as an as a finance type of lease, when one or more of the criteria that we talked about, the O, the W, the N, the S, if one of them happen, voila, I get myself a finance lease. If none of them happen, then it's by default it become an operating lease. So what they give you here, each of the four independent situations. So you have situation 1, 2, 3, and 4. They give you four situations and they ask you a lease requiring annual lease payment of $10,000. Okay, that's the minimum lease payment. Remember the periodic payment, I'm going to pay a $10,000 on an annual basis. For each situation, determine the appropriate lease classification. Is it for each one? I'm going to take it and it's by the lessee. Indicate why. So I have to list the O, the W, and the S to make sure in lease one. And remember, those are independent scenarios. So technically, I'm taking each one separately and I'm dividing one separate from two. Let me just minimize the line. Two, right? 3 and 4. Those are independent situations. So as if you've taken 4 exercises in one exercise, but it's all from the lessee side. So I'm going to read each one separately, and then I will do 2 with you in class, and I'm going to encourage you to do the remaining situation by yourself just to get the habit of calculating, and I'm going to give you the answer key for you to know if you got the right answer or not. Okay, starting with situation 1. Situation 1 says the following. The lease term is for 4 years, and the asset useful life is 6 years. Just by reading that, I can automatically run the 75% rule, 4 over 6. I can do that right away, right? Because it's a simple application, but I don't have to do it now. I'm just reading is there is a lease life and there's a useful life. And this is 4 years versus 6 years, right? So if I run my math, it's about 67%, if you will. or 66.666. But anyway, that would not satisfy the 75% or more. So it's less than 75%. So that's just by reading that. Assets fair value is 44,000, and the purchase option that is reasonably certain to be exercised, no. But they're telling you there is no purchase option. Okay. The annual lease payment happened at the beginning of the year. Remember the diagram that I told you beginning, what table you should be using? And then that beginning, it's annuity due, and it will be table 6-5. Remember, the annual payment is 10,000 as they given the beginning, the heading of the question. The lessor implicit rate is known by the lessee, the 5%. So when I go to the table, I should use the lease term for 4 years, and the implicit rate is 5%. See that? So I get all the details about how to do the calculation. And if I got all the right numbers belongs to each question, I get the answer right. So just be a little careful with all these details. I have 4 years, I have 5% implicit rate, and the incremental borrowing rate is 5%. I would not care about that because why? Because it's known. And the rule of thumb is if they give you the two rates, implicit rate and incremental rate, use the implicit rate if it's known by the lessee. If they come here, it says not known, you automatically jump into the incremental borrowing rate. But what happened at the time here is 5%, 5%. So it's really, but the rule of thumb is I'm using the implicit when it's known to the lessee. Okay. So here is really, I took the criteria 1, 2, 3, 4. So what I'm really saying, which I'm going to abbreviate it for you here, just to make it simple. I'm using the O, I'm using the W, I'm using the N, and the S. But have the S here because this is the 75% rule, and here is the N. I can make it cap. And the S here for the specialized, which is okay. Which is okay. You can put them in the order where you like, but just because I have the answer here, I have to follow the sequence of what is given. The O. Did you hear anything about we're gonna transfer the asset to the lessee and then none? No, did not happen. I'm looking for one or more. Does the agreement contain a bargain purchase? It actually says no, no purchase options, so no. Did we use the 75% rule? I call it the 75% rule. No, really, because if I divide the 4 over the 6, it's going to give me 66.6666 something. So it's not to satisfy the 75% rule. What about the 90%? Remember I told you here's the calculation is all about the 90%. What is the 90% rule says? Let's write it in here. The 90% rule says the present value of minimum lease payment, right, is equal, let's get the equal, or greater than 90%, right, of the fair market value of the assets, of course. So I need to apply the present value of the minimum lease payment equal or greater to 90% of the fair market value. So I'm taking that, okay, present value of the minimum lease payment. How we calculate it is the periodic payment, is the minimum lease payment, which is they said every lease gonna pay at $10,000 on an annual basis. I'm gonna go to the tables and look for the annuity due because they said at the beginning it's gonna be under 4 years. That's the lease term, under 5%. If I run that, I get a rate from the table. The rate is 3.72325. I run my math, it would equal to 37,233. That's the first part of the formula. That's the present value. What is the present value? Is your annual payment beginning and multiplied by the factor that I get from the rate from the tables, which is the beginning, and the beginning is annuity due 4 years under 5%. If you go to the table, you'll find that factor. Multiply, get the present value of the minimum lease payment. That's the first part of the formula. The second part of the formula is I have to get the 90% of the fair market value. The fair market value, it was given to me as $44,000. So the fair value, I'm going to get 90% of that. So I'm going to take the $44,000 and multiply it by 90%, right? That would be equal 39,600. Now all I need to do is comparing these two together. Is the value, the present value of the minimum lease payment equal or greater than 39? In reality, it's not. In reality, is really less, right? The 37 is less. So if the answer to the O is no, and the W is no, and the S 75% is no, and the N is no, and the S is no. I didn't hear anything about alternative use, or so the present value of the minimum lease payment did not happen. So it's everything is no, automatically become an operating lease. If any of these criteria was yes, it will be actually a finance type of lease. Okay. We used to call the finance type of lease back in the days, we used to call it a capital lease, but FASB changed that to a finance type of lease. Okay, so it's not a finance type of lease. Now let's go to the second scenario and let's see if we can tackle it as well. In the second situation set, we have a lease term of 4 years and we have a useful life of 5 years. I see someone automatically taken 4/5 equal 80%. Voila, one criteria happened, so that's automatically a finance stabilis without even looking at the rest. But I'm not. I'm gonna do all the testing because I have to show why, and I'm still learning. I have to show why it's actually a finance stabilis. But just by reading 4 to 5, dividing 4/5, get 80%. That meets the 75% or more of the lease assets is dedicated to the lease term. Okay, asset fair value is 45,000. Purchase option is reasonably certain. I got second yes. So I can have my criteria is one or more. Remember? Annual lease payment happen at the end of the year. So that means if I go to the tables, I'm going to use ordinary annuity. And then I have the implicit rate, and it's known by the lessee, so I can use the 6%. I don't need to use the incremental borrowing rate because the implicit rate is known. So now what I'm going to do, I'm going to again put the four criteria, the O, the W, the N, the S, right? The owns. So let's see, here is the O. Let's put it in capital. Here is does the agreement contain a bargain purchase? That the bargain purchase is the written bargain purchase. Then I have here is the 75%. Here is the 90%, and it's okay if they switch the N with the S, that's in order. And then the final S for the specialized. Okay. Instead of me writing all these verbiage, it's easy just to apply the O, the W, the N, the S, and voila, I get myself which one is it, an operating lease or a capital lease. There was nothing mentioned here about transfer of ownership, so it's no. The bargain purchase, what just in the verbiage is given, it says purchase option that is reasonably certain to be exercised is yes. And then we'll have the S is 4/5. That's 80%, and I can do the math here. Show the 4 years divided by the 5 years equal the 80%. So that actually meet the 75% or more. As for the 90%, we'll do it the same as we did here. The formula says the present value of the minimum lease payment equal or greater than the 90% of fair market value of the assets. And we can apply the present value of the minimum lease payment. We have the lease payment at the minimum is the 10,000, the periodic payment. It happened at the end. That means I'm going to go to the table for ordinary annuity, which is 60-4. Look under the years of the lease is 4 years under 6% this time, the implicit rate. I will find a rate equal 3.46511. If I run my math, I get 34,651. Okay. Now, the fair value, that's the first part of the formula. The second part of the formula is I have to take 90% of the fair market value. Fair market value was given to me. If I go to the top, it says the fair market value is 45,000. I take the 45,000 and multiply it by 90%, and I run my math. This equal to 38,700. So now all I need to do is to compare the present value of the minimum lease payment, which is the 10,000 multiplied by the factor 34 against the 90% of the fair market value, 38. Definitely the 34 is less than the 38. That's why they said no. So if I can look at the criteria in total, the O is no, the W is yes, the S is yes. So if I need one, right, one or more, actually here two happens. It's okay. So that's a finance type of lease. So we took an example about the operating lease, and we took an example about the finance type of lease. I would encourage you to do situation 3 and 4 on your own, and try to apply the OW, the N, the S, and try to come up with the answer. And I would recommend that you actually show the calculation. You don't have to submit that. That's not a homework. I would tell you if the homework is assigned and when you submit it and how you submit it when we come to the homework assignment. But for now, this is just for your own practice. I just did 2 situations. You can do the other 2 situations, and you can tell which one is a finance type of lease and which one is a operating lease. Okay. All right. So now let's go and see how we're going to record the lease. So normally the lease has either we call it the finance type of lease if it's from the lessee side. And the sale type of lease, this is from the lessor side. Remember, it's the two sides to the same coin, but I call it one-time finance. That's the lessee. The lessor call it the sale type of lease. Now, in the verbiage here, this is just to lay the land, how you're going to start to record the journal entries from the lessee side, how you start to record the information from the lessor side. In a finance lease, the lessee will record the right of use assets. So if you're getting an equipment, you're not necessarily debiting the equipment. You debit the right of use assets. So someone will ask me, so what is that account called right of use assets? Intangible assets. You have the right to use, it's literally from the wording, the right to use the assets, utilizing the asset. But also, as much as you get the right to use the assets, you also have a liability for the lease payment, right? Because the assets is you're entitled to use it, but also you have a liability to pay that periodic payment. So when you're going to record the finance lease, you're going to record the right of use assets, and you're going to see these entries in a minute, and the lease liability with the present value. So this is why it's important to learn how to calculate the present value of the lease payment. And I showed you the buckets for the present value of the minimum lease payment. You have the minimum lease payment plus guaranteed, if any, plus the residual value, if any, plus the penalty, if any, right? And then you have the second bucket, the non-lease payment, that you have to have them separate than the minimum payment, which is your insurance, maintenance, or taxation. And then the third bucket that you have the discount rate, it's either you have the implicit and you're going to use it if it's known to the lessee, and you have the incremental borrowing rate, you use it if it's not known to you, the implicit rate. That's really how you calculate the present value. And I showed you, when I showed you situation 1 and 2, how easy that to get the periodic payment multiplied by the present value factor, to either from table, 4 or 5 or 2, based on the scenario of the periodic payment. And then once you multiply it, you compare it by the 90% of the, right, to figure out if it's a finance type of lease or not, in the 90% rule. But in here, we have to know how to calculate the present value. The second, the lessor record the receivable. Wait a minute. So the lease liability, that's the payable side, but the lessor has the receivable because they record it as a sale. But just remember, sometimes that sale, we also need to figure out if that sale has no profit or it has a profit. And when would you figure out that there is a profit or not? If the fair value of the assets equal the cost, then there's no room for profit. But if there's a difference between the present value exceed the cost, then there is a profit. So if there is a difference in the value, will trigger the profit. If there is no difference, there's no profit. Then there is the interest. So they show you, when you record one side from the lessee, one side from the lessor, then the interest, we're going to use something called effective rate, because the interest, which is the implicit rate or the discount rate that we talked about, we need to calculate the interest to accrue also the interest on the balance that you have, because you're going to take whatever outstanding balance. Remember, you have, let's say for discussion's sake, you have $1 million worth of a present value of minimum lease pay, $1 million, and you're going to pay it over 4 years. So you're going to pay it on an installment. But every year, you're going to calculate a piece for the interest and the remaining balance on the principal, and you start to reduce that $1 million all the way for every year, in order for you to consume all the $1 million by the 4 years. So I start with $1 million and I close that $1 million by the end of the 4 years, because every year you're going to take a piece of that payment and pay it, because you leased it for 4 years or 5 years for discussion's sake. Okay. We're going to prepare something called an amortization schedule, and that's to keep track of the principal and interest and what you're paying and what balance is remaining, because this amortization schedule will lead the way to trigger the amounts that you'll be recording on the journal entries. Okay. Amortization is recorded for the right of use assets in a manner consistent with the lessee usual policy. So the amortization, remember when I said the depreciation or amortization, I said if the O or the W exists, you depreciate over the asset life. The N or the S, you depreciate over the lease life. So here they try to tell you what life you should be using when you depreciate that asset. But because the right of use asset is not the asset itself, it's intangible assets. That's why they use the word amortization, because it's not, you're not getting just the equipment, you're getting the right to use the equipment. That's why they consider it an intangible asset, and they use the word amortization for it. With that, let's take an exercise and see how we start to record these journal entries and how to create that amortization schedule. We are using exercise 15.2. This is about the finance lease and how to calculate the lease payments. American Food Services Incorporation leased a packaging machine from Parton and Parton Corporation. Now, when I read names, I really don't care about these names. All I care about who's the lessee, who's the lessor. So American is leasing a machine from. So I got the lessee and I got the lessor. I'm leasing it from the Parton Corporation. So here is the American Food is the lessee. So once I read, I have to filter through the information. I got my lessee. I got my lessor. I'm just, you know, filtering out the information. Okay. The lessor, Parton completed construction of the machine on January 1st, year 21. The lease agreement for the 4 million fair value and present value of the lease payment. So what I'm figuring here, there's no profit because they are the same, the fair value and the present value of the lease payment, all for $4 million. Machine is specified 4 equal payments at the end of each, see that? At the end, not the beginning. So once they tell me the periodic payment at the beginning, I'm going to use the annuity due. At the end, I'm going to use a ordinary annuity. So here is at the end of each year. The useful life of the machine was expected to be 4 years. Wait a minute. So I'm paying for 4 years, right? I'm leasing it for 4 years, right? And I'm also learning that the useful life is 4 years, that 4 over 4, 100, voila, a finance type lease. But wait a minute. The useful life of the machine was expected to be 4 years with no residual value. Okay. Barton implicit interest rate was 10%. And this is the only rate that I got. So I'm not really worrying about the borrowing rate or anything. So I got, who's the lessee? Missing an E here. Who's the lessee? Who's the lessor? Who's the lessee? Who's the lessor? How much I have 4 million, right? This is the present value, fair value. I have 4 years worth of lease. I have 4 years worth of life. And now they ask me to prepare journal entry from the lessee perspective. American is the lessee. At the beginning of January, I need to prepare amortization schedule for the 4 year term for the lease. I need to prepare the appropriate related entries as of December 31st, year 21, and prepare the appropriate entries as of December 23. Remember, the lease started for 4 years, and I need to prepare the schedule. So the first thing first, at the beginning, the first requirement is I have to record the right of use assets from the lessee. I get the right to use the equipment for $4 million to lease payable. Remember when they said you also recorded the liability? Payable is the liability. So lease payable is 4 million. So the entry is simple. Debit right of use assets and credit lease payable. What is the date on that one? As of January 1st, 2021. Then I'm going to come up here, requirement number 2. Prepare the amortization schedule for 4 years term. The amortization schedule, this is how it looks like. It actually has a mechanics to prepare that amortization schedule. I'm going to teach it to you. But before we start, they didn't tell me how much I would be paying on an annual basis every year. They didn't give me how much is the periodic payment. They told me how much is the whole lease value. The present value is $4 million. But they said they're going to pay at the end ordinary annuity. So I'm going to go to the table. I'm going to figure out the factor, the time value for 4 years and at 10%, the implicit rate. I find a factor. Get the $4 million present value divided by the factor of ordinary annuity. You get how much is the lease payment, the periodic lease payment. I did the opposite in situation 1 and 2. I took, remember the lease payment here was 10,000. I took the 10,000 multiplied by the factor. Here is the other way around. They give you the 4 million, but they didn't give you how much is the periodic payment. So it's either, it's either you go from the periodic payment to the present value or from the present value to the periodic payment. In this case, they give me the full amount and then they give you the paid each year at the end. That's why I use the ordinary annuity. Now, how will prepare the lease amortization schedule? I can prepare the lease amortization schedule from the lessee side and from the lessor side. Because I'm starting with the same value from the lessee lessor, it's actually I'm repeating the schedule from the lessee and the lessor's side. So what if I have two different values? And I'm going to show you when we have bargain purchase or we have guaranteed residual. Sometimes we end up have a different starting point from the lessee versus the lessor. Then the mechanics is the same, but just the value that you're starting with would be different. Let's understand first what is the columns that you'll be using in that schedule. First thing is the years or the date, whatever the basis, quarterly basis, annual basis. They said they're gonna pay each year. So I'm breaking down between each year, breaking a line for each year. The first year, second year, third year, fourth year. What if I have 5 years? Build the fifth year, 6 years, 7 years, so on and so forth. Second column is your lease payments. And lease payment has to be consistent. It's periodic, it's an installment basis. It has to be consistent. There is no, I'm not paying in the first year $1 million, in the second year $2 million, in the third year. No, it's a periodic payment, right? So it has to be consistent. That million as a lease payment, I'm paying that payment all the time. So the first year, second year, third year, and fourth year, it's consistent. I'm going to leave the effective interest and the decreasing balance for just 1 second. Starting with the first line, outstanding balance. I start with the value, that the present value that I need to break it down, and I pay each year an amount. And after I pay it, after all the 4 years, the balance is zero. So start with the present value and end up with a zero. Not coming in here on the first year. They said the payment happened at the end of the year. This is like the first line here is kind of blank, right? Starting from the 4 million. Interest normally takes place at the end of the year, not at the beginning of the year. In this scenario, right? Some other scenarios we pay at the beginning. But if in reality, there's two things happen at the end of the year. One is the interest. Two is the depreciation or amortization happen at year end. Let's say for discussion's sake, they said this payment happened at the beginning. So at the beginning of the year, I will not be able to really calculate the interest. The interest should take place at the end of the year. But because this is at the end of the year, you see the interest have calculated here. But let's say if this is the beginning, you will find the first interest calculated in here, not the first year, right? So let's see. How would I do the two columns here? So we have the years or the payment, the how periodic that is, quarterly, annual in here. Payment lease is consistent. Then I have a column for the effective interest and the decrease in balance. What is that? I take the first initial present value and I take that and multiply by the interest rate. If I take a 4 million multiplied by 10%, which is the given interest rate. If you recall from the exercise, if I go back, it was 10%. That equal $400,000. Just the interest on the balance. Remember when I said you're gonna pay every year a periodic payment of 1,261,881? Okay, 400 of that is interest. What is the remaining on the million point or the 1.2? Is the 861,881. So this is like if I add these two together, this should equal the periodic payment, right? So in that 1,000,002, part of it go into the interest, part of it go into the decreasing balance, the principal, the remaining principal. These two should equal to the periodic payment. Okay, then what happened? So I'll take the 861,881, that's the decreasing balance, that's the principal amount that I reduce it from the 4 million. And if I run the math, I deduct the 861,881 from the 4 million, I end up with three remaining balance of 3,138,119. And I run it again, repeat it again, take that 3,138,119 multiplied by the 10%, get the amount related to the interest. The remaining interest on the 1.2 is the 948,069. So this is again as if I'm adding these two together. Let me just minimize the size on here just to fit the schedule. If I do the same, if I take the interest of 313,812 out of 1,261,000, I get 948,069. So that's the principal. So every year, the interest and principal equal the periodic payment. The interest and principal equal the periodic payment. The interest and principal equal the periodic payment. The interest and principal equal the periodic. It has to equal the periodic payment. But every year I take that principal remaining, the decreasing balance, and deduct it from the outstanding balance to get whatever the remaining. So if I take the 948,069 from 3,138, the remaining will be the 2,190,050. And I keep repeating that for 2 years, 5 years, 6 years. But come to the final year. So I'm going to repeat the same. I'll take the periodic payment. A piece of it going to go from that balance. A piece of it going to go to the interest, the 2,190,050 multiplied by 10%, get a piece of it interest, and the remaining of the periodic payment will be the principal. Then I'll reduce that 1,042,876 from 2,190 here. Just be careful with the last year. Why? Because in the last year, are I supposed to take that amount, right, and deduct it from the balance? I should end up with a zero. But if you run the actual math, and you take the remaining balance the year before the last year, and you multiply it by 10% to get the interest. If I multiply 1,147,174 by 10%, so if I'm gonna move the 114. See that 114 comma is supposed to be 717, right? But I put it 114707. Why? Because I'm forcing the schedule to work. It's just a few dollars, by the way. This is just few dollars. Could be $5, $6. It's just I'm trying to come up with exactly the final remaining balance to equal the outstanding balance to equal zero. So this number has to be exactly that. So I'm kind of like tucking in whatever is remaining in the interest, if you will, just to come up with the zero balance. So here is a look, it's just a rounding. So here even they put a star here at the 707 because it's supposed to be 717, like $10 adjusted for rounding of other numbers in the schedule. You never round up 1,000 and or a mil or something really big. It's just very, very small dollars in order for you to just adjust the schedule to end up with a zero. To recap the schedule, how it works. To prepare the lease amortization schedule, you have to start with the present value of the lease. This is become your outstanding balance, the 4 million, supposed to be paid all the way to zero. You have the first column is the periodic, how you gonna pay it, annual, quarterly, semi-annual. So first year, second year, third year, fourth year, because they told me they have a lease term of 4 years. You have your lease payment. And I figured out my lease payment. I took the present value divided by the factor of ordinary annuity for this case because they said at the end of each year. Got my periodic consistently, right, across the board of all 4 years. Take the 4 million, take a 10% of that, equal $400,000. 400 minus the 1,261,881 equal 861,881. Take the 861,881 minus the 4 million, give you 3,138,119. Take that balance, start all over, 10%, a piece of it to the interest, a piece of it to reduce it from the periodic payment, come up with a decrease in balance, minus the outstanding balance, come up with the new remaining balance. Take that new remaining balance, come with the 10%, a piece of it interest, minus the periodic payment, give you the remaining. Take that remaining minus the balance, give you the new remaining balance. Take that, multiply by 10%. If you have any remaining, to make the final decrease in balance equal the remaining balance, they have to equal zero. Tuck in any remaining in the interest just to make it really reasonable for you to come up with the same. Say here 1,147,174, same exact dollar figure to come with a zero. Here is the total showing you the lease payment. You ended up with paying 5 million that really than 4 million. So this is why the lessor put the desired rate of return as 10% because they're not idiots. They're going to get their 4 million and more. See that? In reality, you decrease that 4 million, but in the interest, you got that 1,047. That's what the actual return. You give an asset, you give the right of the use asset to the lessee to use it, and you get a return of 1,047,524. That's a good deal. Now we've been asked to prepare the journal entries, and just to show you, we've been asked to record the journal entry in year 21 and in year 23. That was the requirement on the question. Just to bring to your attention, the journal entries coming from the schedule. So if you prepare your amortization schedule correctly, your numbers on the journal entries will be correct. And God forbid, if you get the numbers on the amortization schedules incorrect, then your journal entries not going to be correct either. So be careful with the numbers. So you would notice that if I need to record the interest and the lease payable is going to be coming, here is the interest for that year, for year 21, 408.61. But these total equal to the periodic payment. If in year 23, I will be recording the 219,005 interest and the payable of 1042. You get the idea? And that would be the payment of 1,261,881. And any year, you could be recording journal entries for each year, but the author here requested year 21 and year 23. So let's go to the journal entries. The request was to prepare the appropriate entries related to the lease on December 31st, year 21. So Remember the interest and 861, I told you, here is the interest expense. $400,000, it was the 4 million multiplied by 10%. Lease payable was the difference of 861, and the cash payment is the million. It's periodic, consistent payment of a million, 261,881. As of December each year, as I told you about the interest, we record the interest and we record the amortization expense. We have 4 million divided by 4 years. First of all, is that a finance type of lease? Yes, remember it's a 4/4, it's 100%. Right? It was a finance type of lease. But you should figure out what lease term or life term. What happened in this question, both of them are the same. So it didn't matter. You don't have to test it. The O or the W, I have to take the 4 years lease term, or it's the N or the S, I'm taking the other. I'm sorry, if the O or the W taken the asset life as your base, if the N or the S you take in the lease life or the lease term as the base. Here you took the 4 million divided by 4 is 1 million amortization expense to right of use assets. So in the beginning, as of January, you recorded as a lessee, you recorded debit right of use assets for $4 million and you credit lease payable. That was the first entry. The second entry here, after you prepared the amortization schedule, you got these items from your amortization schedule. Those are your calculations. They ask you to do the same for year 23. Year 23, I have the 219 as I showed you on the schedule. Interest expense and any expenses and payable and liability gonna happen from the lessee side. Any receivable and revenue is gonna happen from the lessor side. But in this question in particular, they were asking from the lessee side. So here is the interest expense, 219,005. Lease payable is a 1,042,000 to cash payment periodic, 1,261,881. And again, at the end of each year, we're going to calculate the amortization expense. Just remember the 219 and 142, and remember the 400 and 861. I'm going to go one more time to the amortization schedule just to show you where we got those. So here is the 400 and the 861, and here is the 219 and the 1,042. Just these two equal to the periodic payment of 1,261. Okay, so I hope you really try to do the amortization schedule on your own. As you see, nothing here is really complicated. It's just a lot of details to master, if you will. So as they always say, practice makes perfect. So try to really take the information, utilize it, practice it multiple times, and believe me, you're gonna uh, in good shape, really perfectly assigning all these information together and put it in an answer format that it's giving you the right direction to answer the questions. You got the owns, the O, the W, the N, the S, the classification of finance type of lease, operating lease, how you prepare the amortization schedule, how you record the journal entries in the beginning when you get the right of use assets to lease payable, how to record the interest expense and lease payable based on your schedule as we saw here, and you pay your cash payment here for the periodic payment, and how you recorded the amortization expense based on the lease term or the depreciation. You also learn how to do the search in the tables, periodic payment beginning or ending. I think up to this point you should be really practice all these parts that we were talking about. Okay. Now we're moving on to learn the same finance type of lease, but this time it's the same question. But one time you're gonna do it from the lessor side, and one time you're gonna do it from the lessee side. They both are same exact question. One is 15 exercise 15.6, and the other one is exercise 15.7. And the only thing you're going to learn here really how you report the lease or account for the lease from both sides, the lessee and the lessor, while you're using the same format. But you need to know who's going to record the receivable, who's going to record the payable, how the journal entry is going to look like from the two sides to the story. So let's just start the exercise. The exercise saying, and let me try to make it a little bit bigger. It's a finance type of lease, but not because they give you the heading, I want you to come up with the answer on your own. Is it finance or it's not? But here at least you got the direction. It is a finance type of lease and it's from the lessee side. Manufacturers Southern leased high-tech electronic equipment from Edison. So here is the lessee and here is the lessor. The manufacturers lease something from Edison. So here is the lessee, here is the lessor. They got electronic equipment. In this case, on January 1st, year 21, Edison purchased the equipment from International Machine at a cost of 112 and $80. Here's the related information. You have lease term 2 years, 8 quarterly periods. So I don't have the annual basis. I have 8 quarter periods. So when I prepare the amortization schedule, I will prepare it for 8 lines, if you will, because it's 8 periodic payment. I have quarterly rental payment, 15,000 at the beginning of each year. I have beginning of each year. That means is annuity. Here we go, annuity due. Economic life of the assets is 2 years. A lease term is 2 years. Economic life 2 years. 2 years. 2 years. 2 years. 2 years. We got voila. Finance type of lease. The fair value of the assets is 112.80, and the implicit interest rate is 8%. Also, the lessee incremental borrowing rate is 8%. I only have the one rate, 8%. I'm not using any other rate. Prepare lease amortization schedule and appropriate entries for manufacturers Southern from the beginning of the lease through January 1st, 2022. Amortization is recorded at the end of each fiscal year, December 31st, on a straight line basis. Is the same exact information, same exact, all what I just read, but this time is prepare the lease amortization schedule and appropriate entries from the Edison leasing from the beginning, right? So Edison is the lessor. So they ask you to prepare one time from lessee, one time from the lessor. I know I introduced the amortization schedule, so I would encourage you. I will show it to you on the screen, but I would encourage you to do it on your own. You're gonna see it here on the screen. They said the periodic payment is quarterly rental payment rather is 15,000 at the beginning of each period. So you have the 2%. Why 2%? Because I have 8% is the implicit rate divided by 4 quarters. So that equals 2%. And they give you the periodic payment would be the 15,000 across the board. And the present value is 112,080, which is actually being given also in the related information, but they give it to you as the fair value of the assets, and that's confirmed that the present value equal the fair value. So if you're doing it from the lessor side, there is no selling profit because the value is the same. Same schedule on the lessee side is going to be the same schedule on the lessor side. We're going to start with the 112,080. But just remember, this is beginning. They said at the beginning. And normally, in order for you to calculate the interest, you cannot, as of 1/1, you don't have time lapsed already to calculate the interest. The interest takes place at the end of the year. So as of 1/1, there's time gap. You cannot see that. You will not be able. So here it's just recording the balance, but here you cannot put the interest because at the beginning year, as of 1/1, you not really accumulate the time on lapsing of time to calculate the interest at year end. So the interest gonna take place at the beginning of the second year, which beginning of second year means ending of the first year, right? Right. The ending, or let's put it the way we put it normally in accounting, the ending of the first year is the beginning of the second year. The ending of the second year is the beginning of the third year, and so on and so forth. So if we start with a balance with 112, and we're going to have a periodic payment. So remember, here's the basis for the payment. We have 8 payments of 15,000 across the board. You take the first one, right? There is no interest be calculated. It's different than the exercise that I gave you earlier because it was the payment happened at the end of the year and you already at the end, so you can calculate the interest on the balance. But in this case, it's as 1 the time did not lapse yet. So the 15,000, there's no reduction of interest, so the whole 15,000 will be the decrease in balance. So here is like a zero, really. I'm going to write zero here, interest. So zero interest, zero minus 15,000, or 15,000 minus the zero. 15,000 minus 0 equal to 15,000. 15,000 minus 112 equal 9780. Take the 9780, multiply by your interest. Someone will ask me, where did you get the 2%? Didn't you say 8%? Yes, but it's a quarterly payment. So 8% divided by the quarter payment equal 2%. So that would be an interest, a piece of it interest from the 15,000, and the remaining would be the reduction in balance. The 15,000 minus the interest give you the 13,000. 13 minus the 97 equal 84. Take the 84 multiplied by the 2%, piece of interest, principal. Then the reduction of the balance, 70,000, so on and so forth. Come here to the end. 14,705 is the same 14,705. You see that? So I'm sure here, which should, when you deduct 14,705 from the balance, should equal to a zero. When you calculate the interest, if you take 14,705 multiplied by 2%, I'm sure there is some rounding number, right? Let's try that. If you have a calculator, you would take the 14,705 multiplied by 2%, that actually equal 294.1. But if I want to get the 294 plus the 14,705, I have to make it equal 15,000. See that if you add these two together, it has to equal 15,000. And that plus is across the board. So all that plus is plus 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 here. So 1942 plus 13,058 should equal 15,000 for every year. That 15,000 is the combination between 1680 and 13,320 equal 15,000. Now, tucking in any difference, so here is the 295 plus 14,705 equal the 15,000, and the difference between the 14,705 and the 14,705 equal a zero. So I paid the payment is 120,000. I have my interest and I have the decrease in balance, and I can repeat the same amortization schedule from the lessor side. So here is from the lessor side, the lease payment, the effective decrease in balance, same exact thing, because my starting point is the same, payment is the same, everything is the same. So you can prepare one schedule and say let's see lessor, but I would recommend you always prepare two schedules actually, unless it's the same, unless so now here is the magic really. For the first time I would see how is recorded in the lessor, but in order to give you the benefit of learning lessee lessor as the two sides of the coin at the same time, I prepared that schedule for you to get to see both of them. So here is the lessee, here is the lessor. Right of use assets from the lessee to lease payable for the 112, which is the present value, 112.80. And lease payable to cash. Remember, the first year as of January, I paid all the 15,000. There was no interest calculated. So if you notice, when I prepare the journal entry, I have to list under what date, because I have periodic payment. It could be on an annual basis, maybe I'm recording in January and December, maybe I'm recording in April. So I have to put the date. So the date is based on my schedule of amortization is January 1st. I recorded the lease, the right of use assets, lease payable, the liability, and pay my first payment. From the lessor is a little bit different. I'll just minimize it here. See, here is the right of use assets and lease payable. Here is the payable here, the receivable here. And I give away the equipment because the lessee will not be able to use the equipment unless I gave them the equipment. So I'm actually kind of removing the equipment from my books. So as of January 1st, year 21, I record the lease receivable with the fair value and the equipment with the cost, which is the same value, no selling profit, with the 112.80. And then if the lessee is payable, will be here my receivable. The lease payable to cash will be the opposite, will be cash to receivable, and no depreciation. We at the beginning with January 1st, there is no depreciation. As of April, I'm just gonna start to record the interest and the payable. And where is this coming from, Professor? This is coming from the schedule. If you go to the schedule, you'll find the two pieces, the interest and the principal reduction equal to the payment of 15,000. But here is the interest expense, lease payable and cash. The other side of the mirror, the cash is credit here, the cash is debit here. Lease payable, lease receivable. Interest expense, interest revenue. You get the idea? It's the same exact. So 1942, 1358 is the same amount to 15,000, but it's the opposite side. No depreciation. As of July, repeating the same entry, but with the different amount, the different two items of the interest and the principal, with the payment of 15,000 for that quarter. Same thing, taking the cash credit will become a debit, lease payable become receivable, interest expense become interest revenue. No depreciation. October 1st, repeating the same. All I'm doing is the same exact entry. Keep repeating, repeating, repeating. The same as I did with the schedule of amortization. But one time, the payable here on the side, the receivable here on the side. Come to December. December is the end of the year. Okay. What I'm doing here, I'm actually accruing for the interest of 1142. I'm accruing for it. So December is the fourth quarter, right? So uh, I have the first quarter, second quarter, third quarter, and fourth quarter. Fourth quarter is the December 31st. I only accruing for the interest, and you will see this on the schedule. You will see that number from the schedule to interest payable. But at the end of the year, normally the depreciation take place. Remember when I said that? Amortization expense, so take that divided by 2 years, right of use assets. There is no depreciation here. What you accruing for interest expense and payable, you have the receivable and the revenue here. Coming again, the new year. Remember, it's 2 years, and each year has 4 quarters. So that's why we have 8 quarters. Now coming to the second year, first quarter, I'm gonna have the accrued interest, the 1142, and the payable to the 15,000, and I'm gonna repeat over and over. I'm gonna do that for 4 years. So sometimes the author give you a year worth of recording, 2 years, or a year and skip a year, skip a quarter, and give you another quarter. So the first exercise that we did, they ask you for 2 different years. They ask you for year 2021 and year 2023. So they skip the year in between. Here they ask for each quarter, for each year, and the first quarter of the second year. You get the idea? Okay, so uh, just remember every time I go over an exercise with you in class, my recommendation is for you always to do it on your own, and make sure that you get the right answer, because this is really the heart and soul of lease accounting, that you'll be able to practice all these concepts and all these exercises and be able to apply the calculations and be comfortable with searching the tables, come up with the factor, learning all the details about the annuity due, ordinary annuity. So far, up to this exercise, you learn, and I'm recapping what we learned so far, because I don't want you to get lost. I want you to really be in good shape. So what we covered so far, um, why we lease, right? Why we don't buy. So remember, we have tax benefits, we have incentive to keep our cash flow, and we get to finance our lease through the leasing companies and not necessarily go to the bank and borrow money to get the leased assets. Could be subject to technology or so. So we'll learn the benefits going into lease agreements. The two parties that get involved in the accounting, the lessee lessor. We learned the classification of the lease. We have from the lessee's side, we have the finance versus the sale type of lease from the lessor's side, or operating from lessee lessor. We learned the classification of the finance type of lease. We have the O, the W, the N, the SCS. We learned how to calculate the percentage value of the minimum lease payment. We learned how to calculate the 75% and 95%, I'm sorry, the 90% rule and the 75% rule. We learned how to run the journal entries from the lessee's side, the lessor's side. We learned how to do the amortization schedule from the lessee's side, lessor's side. And if you come to this point and you really understand how to do all the calculations that we went over, I think you should be in perfect shape. Lease is considered to be very comprehensive type of topic. Has a lot of details, but it's so much manageable if you have everything in line and everything in order and everything is organized. And I'm trying to organize my lecture really in a way that be simplify it for you, using these diagrams and explanations and things to guide you along the way. And if you ever have any difficulties understanding anything, reach out to me and I will be more than happy to help you. Um, but so far, this is what we covered. Now, we're gonna move on to the sale type lease with selling profit. So we learned from lessee and lessor. The lessor treated as a sale type lease, while the lessor treated as a finance lease. But from the lessor, the owner perspective, these leases could be with profit or without profit. So what we learned so far was without. Why? Because the present value equal to the fair value, or the fair value equal to the cost of the assets. Now, when the lease from the lessor side considered to be a sale type of leases with selling profit, here's when it happened. This occurs when the fair value of the assets exceed the cost or the carrying value. That makes sense. If I have a fair value of $1 million, but the cost is 750, there is a 250 in between that considered to be the profit. But if the fair value equal to the cost, there is no selling profit at this point. But if there is, and there is a difference between the two values, then the lessor should recognize a selling profit at the beginning of the lease term. Selling profit is the difference between the sales revenue and the cost of goods sold. Lessor also recognized interest revenue over the lease term, and that's what you saw when we have the lessee lessor. You saw the lease receivable and the interest, and they get the revenue side. The lessee has all the liability payable side. So with that, we are ready to take one exercise actually to see how we apply the sale tab lease with the profit. So here's exercise 15.8. This is the sales tab lease with selling profit from the lessor side, and we need to calculate the lease payment. Manufacturers, Southern leased high-tech electronic equipment rather, from International Machines on January 1st, year 21. International Machines manufactured the equipment at a cost of $85,000. Manufacturers Southern's fiscal year ending December 31st. So who's the lessee, who's the lessor? From International is the lessor, manufacturers is the lessee. The related information, lease term, 2 years, 8 quarters. Okay, we learned that before. Quarterly rental payment, 15,000. That sounds like what we just learned. Beginning of each period. Okay, economic life is 2 years, 2 and 2. Fair value of the assets is 112.80, and the implicit interest rate is 8%. Then Then they said, show how international is the lessor, determine the 15,000 quarterly lease payment. We can show them that. And prepare the appropriate entries for the international is the lessor again, to record the lease at the beginning annuity due. As of January 1st, 21, and the second lease payment on April. Okay, because it's quarterly. So now, few things that I want you to be careful with. Did you see there is a fair value of the assets of 112.80, but there is a cost of the assets of 85,000? Did you notice that? Cost, fair value. Two different amounts that should trigger the selling profit. Okay. When that happens, we're going to have very unique journal entries, different than the way we recorded before. But first thing first, let's answer question one. How we going to come up with the 15,000 that they said it is? The formula is simple, which is really what you learned so far. The amount to be recovered is your fair value, the 112. I divided by the factor from the table, which annuity due for 8 quarters, right? At 2%, you'll find the rate. They give you the periodic payment of 15,000. Even though they give you the 15,000, what they asking you, how can you come up with the 15,000? So I took the fair value. I normally call the fair value amount to be recovered divided by the factor from the table. It gives you the periodic payment. Sometimes it happened the opposite, as I showed you before. Remember in the first, when I give you exercise situation 1 and situation 2, they were giving you the periodic payment of 10,000, and we multiplied by the factor to come up um, with the present value. Now they give you the present value slash fair value, and they said, okay, come up with the periodic payment, even though it was given, but I can show them where I get it. Most likely they were testing you on how to search really the factor from the table, and you can distinguish between beginning, ending, annuity due, ordinary annuity. So here is the unique entry that I want you to be comfortable with. As of January 1st, I need to record the lease receivable. Remember, I'm on the lessor side. The lease receivable, which is the present value, fair value, 112.80, which was given. But I have a cost of goods sold, which is the cost, $85,000, the book value. Sales revenue, which is the amount of the fair value, to the equipment, 85,000. So I can actually, I want you to look at this entry as such. Let me just draw the lines first, and then I will explain it to you. So if you see from the colors, the blue color is really, if I'm dissecting that entry, I see that the lease receivable, so as if I'm debiting lease receivable to sales revenue. This is like any receivable, right? Accounts receivable to revenue. Remember that normal journal entry in our accounting. So lease receivable to sales revenue, 112.80. Okay. Cost of goods sold to equipment, normal cost of goods sold, right? To equipment. But again, I'm recording lease receivable with the fair value. I'm recording the cost of goods sold with the book, with the cost. I'm recording the sales with the fair value. I'm recording the equipment with the cost. So one entry is the fair value, one entry is the cost. So the unique entry when you have a selling profit is to record the cost of goods sold, and you record the sales revenue. This is In normal we record the lease receivable and revenue, but we don't actually record the cost of goods sold and stuff like that. If you recall, what I just did from the exercise prior to that was exercise 15.6 and 15.7. What I recorded, if you can go back, I recorded lease receivable in the beginning to equipment, right? I got rid of the equipment. So this is not how I recorded when I have just a sale tab lease. Now I will have the periodic payment, collection of the periodic payment on the lessee side. You paying, I'm receiving as a lessor. So debiting cash, credit lease receivable with the lease payment. You're not making the payment, you're receiving the payment. In April, we have like a normal one, the same as we did exercise 15.6 and 15.7. The cash, you take in the 15,000 lease receivable and the interest revenue with the amount of interest, and you can find those on the table as we covered before. So the only unique thing again about the selling with profit is the value of the fair value of the asset is different than the cost, and that would trigger that entry of the lease receivable to sales revenue and cost of goods sold to equipment. Okay, all right. Now we're moving along. We finished so far the first top section. If I just remind you, I'm gonna go back to show you where I started, where I broke it down. All I did so far, I finished that top portion. I'm above that line. I finished the lessee finance lease versus lessor sale type of lease without and with. Now I'm gonna go and do the operating. You got the idea? This is the lay of the land. We finished the top portion, finance and sale. Now we're gonna do the operating. Okay? So we'll go to the operating, and now let's understand what is the operating lease mean. Simple as I did not meet any of the criteria of the owns. Okay. Here is lessee merely uses the asset temporarily. That means you're gonna return it back. And even if you have a finance tab lease and there is no asset transfer, you're gonna return it at the end of the lease. But here you temporarily have the use to the asset. A sale is not recorded by the lessor. The lessor record revenue on a straight line basis because it's going to be a periodic, every year. We're going to see some exercises to that. So the only unique part about operating lease is how you recorded the amortization. So when we did the finance tab lease and sale tab lease, we took the right of use assets and we divide it over, and it depends if it's OW and the NES, whatever the base, and we divide it over the life to get the amortization. It's kind of like the depreciation really, but we call it amortization because it's intangible, as I mentioned before. But here the lessee will record the interest the normal way and then uses a plug number to record the right of assets amortization at whatever amount is needed for interest plus amortization to equal the straight line lease payment. The periodic payment that we use to break it between interest and principal is going to look here almost like it's the same number, but we treat it differently. We use that plug number as the amortization, and I'm going to show it to you an example so you get an idea what I'm talking about. So let's take the example. This is exercise 15.13. This is from the lessee side. It's talking about operating lease effect on the financial statements. And also exercise 15.14. So Professor, why are you giving us two exercises in the same scenario? Because it's the same information, but one side is from the lessee and one side from the lessor. That's why I'm combining the two in one. So when I answer, I divide it in half and I give you one side lessee and one side lessor to make it easier on you for you when you study. So here's the lessee operating lease effect on the financial statement, and the same information, but this time from the lessor. And just remember, they both about operating lease. So the information is as follow. At January 1st, year 21, Cafe Mid leased restaurant equipment from Crescent Corporation under a 9-year lease agreement. Now we learn who is the lessee, who is the lessor. The lease agreement specifies annual payment of $25,000 beginning each January 2021, the beginning of the lease, and each December 31st thereafter through 2028. The equipment was acquired recently by Crescent at a cost of 180, its fair value, and was expected to have a useful life of 13 years with no salvage value at the end of its life. Because the lease term is only 9 years, the asset does have an expected residual value at the end of the lease of 50,995. Crescent seeks a 10% return on its lease investment. By this arrangement, the lease is deemed to be an operating lease. The author is dedicating to you, or providing you rather, with some information, and they tell you that's an operating lease. My advice to my students always, if the author give you an information, don't try to reinvent the wheels to figure out if it's an operating lease. Or you can, but if they give it to you straightforward, it's an operating lease, operating lease. Reality speaking, if you get the data as you get, and you test the O, the W, the N, the S, and none of these criteria satisfied, automatically become by default an operating lease. So they ask you what would impact the earning and what would be the balance on the balance sheet and ignore taxes and stuff like that. I think the best thing is to show you really where is these journal entries rather than just show you the income statement and stuff. But I'm going to show it to you briefly, but I will focus on the journal entry rather. So here they show you how the income statement will be prepared. The interest, they're going to take the 158,373 and we're going to say, where do you get that number, Professor? This is the periodic payment, the present value, multiplied by the annuity due, which is 9 periods, 10%, you get the amount. This is, they calculate the interest, take away, so this is the present value, take away the first payment at 10%, give you the interest. The amortization for the year will be the plug number. So instead of going through this part, I'll show you the easiest part first, and then we'll come up with the calculation. So best things to do is, I'm just going to go back just 1 second just to show you again the calculation here, and then I'll use it again. In order for me to come up with the present value, I normally take the periodic payment and multiply by the factor from the table. So what I need here is that number, 158,373 is the present value. Now I'm the one who actually created this table for you. I took the outstanding balance. I took the payment has been specified in this example that we're going to pay the first payment as of 1/1, then after that as of December 31st. That's what's dictated by the lease agreement. Take that 158. I know the periodic payment is consistent, 25, 25. This is just a sub schedule, if you will, not the full schedule. I just prepared only for the years that I need. As of 1/1, remember the interest should not be accumulated because we at from 1/1 to 1/1 there's no time lapses, so there's no interest. So decrease is going to be the full 25,000. 25,000 minus 158,373 equal 133,373. Take that, multiply by the interest, and so on and so forth. Now here's what I really want you to show, the difference between recording operating lease between the lessee and the lessor. As of 1/1, the lessee will record the right of use asset. This is look like exactly like the finance type of lease. Yes, but you have the right of use assets here temporarily. So the entry look the same. Right of use asset to lease payable. But here in the lessor, I did not record lease receivable and get rid of the equipment. I didn't do that. There is no entry to record or to de-recognize the assets, means removing the assets. None, because that was just a temporary use. I'm still, as a lessor, I'm still the owner. I have my assets with me. It didn't go to you. You only have temporary use of it under the operating lease. Then you're going to pay your periodic payment of 25,000. Lease payable to cash. Remember, because as of 1/1, there's no accumulation of interest yet. The lessor will take that cash, and the lease payable will be deferred lease revenue. Why deferred? As of 1/1. Excuse me. So that deferred will become revenue at year end. As of December, interest expense, lease payable, and cash. Professor, where you got these numbers from? I got them from here, right? So here's the 13, here's the interest, here's the 11,663. All I need to just get them from the schedule. But what happened here, the deferred become lease revenue of 25,000. I take the same, that 25,000 that you're gonna pay in the second year. I'm sorry, at the end of the year, become cash to deferred lease revenue, as if I'm accruing for it for the second lease payment. But you notice here the uniqueness. The lessee will record amortization expense, but he will never take that 158,373 and divide it over to either the lease term or the useful life based on OW, because does not apply here the OWNS. The plug number, remember I told you how the plug number would work? So you take the periodic payment, which is 25,000, minus the interest, right? That would be the plug number. It seemed like the 11,663 match exactly the principal amount, the lease payable reduction. Remember that? But this is actually a plug number between the periodic payment and the interest equal the amortization to the right of use assets. So I did not do the amortization in the normal way that I take the total present value divided by the useful life or the lease term based on the OWNS. This is not applicable here. What is applicable here is a plug number between the periodic payment and the interest. The difference between the two become a plug number, and it's the entry is amortization expense, the right of use asset. Coming to the lessor side, because you're still the owner, you're actually depreciating assets. This is only using amortization because it's right of use assets intangible. Here is depreciation of assets. I take the full value of the assets. Professor, where you get the 180? It was given in the question. If I can go back to the question. This is question number, all right? It was given to me. Let me just go back to the question. The equipment was acquired but a cost of 180. It's fair value. So the lessor will take the 180 divided by the useful life, because you're the owner, that you got the whole assets. The useful life was 13 years. Depreciation expense, accumulated depreciation for equipment. This is a normal entry in our world if you have the equipment and you have a depreciation. As you saw, the distinction between finance type of lease and operating lease, the operating almost on the lessee side similar to what we learned. Everything sounds same, looks same, except that the amortization expense is treated as a plug number. On the lessor side, you will take the receivable and it becomes your, I'm sorry, you will take the cash and it become a periodic revenue to you. You're just accruing for the revenue for the year, and then you actually recognizing the revenue, but then you're going to record the depreciation expense. For the first time I saw the depreciation, if you go back and compare that exercise to the first exercise that I cover, um, I think it was exercise 15 too. When I covered the lessor, I said no depreciation, no depreciation, no depreciation. But actually, when it comes to operating, the lessor is the owner of the assets, and you only give a temporary right of the assets to a lessee. So you need to calculate the depreciation. Someone will look at it and say, "Am I calculating twice depreciation expense and amortization expense? See how much here you actually recorded as a lessee and as a lessor. You're not even recording the same amount. Is the base is different, the calculation is different. Here is the plug number between the periodic payment and the interest. We're plugging the difference. It happened to be the same difference here because you're always gonna come up with that. And then here is the depreciation, which is the total value of the assets divided by the useful life, the economic life, the longer life of the assets. Okay. Now we're moving along to a new uh, tab of lease. They call it the short-term lease. And the uniqueness about that short-term lease, they consider it as a shortcut. This is the simplest, easiest way of recognizing a lease, but only criteria that need to satisfy for that type to be used and calculated is a lease has a maximum possible lease term, including any option to review, of 12 months or less. So if you notice to all the lease exercises that we covered has like 4 years, 13 years, this year, this, no, no, no. This is a very short period of lease term, a year or less. If that happens, you use the short cut method or the short term lease. It's very simple calculation, very straightforward. There's no complication whatsoever. The lessee here can select to not to recognize the right of use assets and or lease liabilities, and only to recognize just to the lease payment as an expense over the lease term. You're going to see it in a way that and the lessor will recognize it as lease revenue. So we'll take an exercise here on the short term, and I will show you the entry. So exercise 1518 is about a short-term lease. Chance Enterprise leased equipment from Third Bank. So Third Bank is the lessor and the Chance is the lessee. They leased it on January 1st, 21, and Chance elected a short-term lease option. Even if they didn't tell me that information, I should figure out from here. Its lease term is 1 year, 12 months or less. Monthly lease payment is $15,000 at January 1st through December 1st. Economic life is 5 years and interest rate is 8%. Prepare the appropriate entries for chance from the beginning of the lease through April 21st. So it's a short-term lease, and the lessee selected. We're not gonna use the right of use assets. We're gonna use every year. I'm sorry, every month rather, the payment. Lease expense to cash, lease expense to cash, lease expense to cash, lease expense to cash. 15,000, 15,000, 15,000, 15,000. It's a periodic payment every month. Very simple. Expense to cash, expense to cash. If I'm on the source side, it will be cash to lease revenue, cash to lease revenue, cash to lease revenue, cash to lease revenue. 1, 2, 3, 4. Got the idea? It's the simplest, easiest way. One will record, the lessee will record the lease expense to cash, the lessor will record cash to lease revenue. Good to go? Good to go. Let's uh let's use a new topic here. And the new topic is a residual value. This is an important part of the lease section or the accounting for leases. And we have to understand what is the residual value mean. In our world of accounting, if you have an asset and at the end of, like, let's say you're gonna calculate the depreciation, you use the wording, remember in the formula, um, the value of the asset minus salvage value. That's the residual value. That's the remaining value on the assets. So when the lessee get the right to use the assets from the lessor, when they set the agreement for the lease, they come up with the agreement. I'm going to pay a minimum payment, a periodic payment, and I'm going to pay a guarantee residual value, if any. I'm taking you back to early in the chapter when I talked about, um, let me see the part, just as a reminder. When I'm talking about the present value of the minimum lease payment, I talked about minimum rental payment plus guarantee residual value. And this is the time that we're going to add, if any. That's the part that I'm trying to teach you. But also you're going to learn from lessee and lessor when it's guaranteed, when it's not guaranteed. That's the part that we really try to tackle here. That if there is a residual value, what would it do? How we treat it from the lessee and lessor's perspective. So back to the residual value. Residual value is an estimate of what the leased assets commercial value will be at the end of the lease term. Simply stating, what the lessor would expect from the lessee when you return the assets to the lessor, how much value on that asset would be when you return it. So let's say there is an asset that the lessor give the right to the lessee to use it for 4 years. And it's, let's say it's $100,000 worth of assets. So if I break it into 4 years, each year periodic payment, let's say 25,000, and you come up to the value of the assets worth zero at the end of lease term. And then you're going to return it to the lessor. The lessor doesn't want that. In reality, the lessor want the lessee, when they return the asset, it still have some value into it, not to zero, because the lessor could actually lease it again or sell it with some value into it. If you're going to reduce it into zero, so the lessor doesn't have the full benefit of the lease. They want the value of the asset to have some residual value into it. And to actually confirm that, they put in the lease agreement, if you're guaranteeing to pay a residual value at a value that is like with a cash payment exceed the amount that you're guaranteeing. We're going to see some examples about guaranteeing residual value. But the residual value affects several aspects of lease accounting. It's going to impact the periodic payment, how we're going to classify the lease, and the amount that would be recorded by the lessee and the lessor. Okay? So, with that, we're going to talk about predicted cash payment. What is that and what it means? So, the lessee sometimes give out cash payment that predict to be paid when the lessee is guaranteed the residual value, and it's going to be treated the same as you give additional payment in the lease payment. So remember the if any that I went back to show you, the if any plus the if any. So sometimes, as they said, a lease agreement sometimes include a guarantee By the lessee. You see the EE. You see how is that similar? Guarantee by lessee. How is that would make a difference to the lessor? The lessor always protects himself or herself when they go into the lease agreement that they're gonna get a return, especially when they put that discount rate, that they're gonna get the asset worth when they give it or they lease it, they actually gonna get a return on that lease. In addition to that, if the agreement dictate that the lessee will guarantee that the lessor will recover a specified residual value when the custody of the assets revert back, means I'm going to take that equipment, I'm going to lease it, and after I utilize it for 4 years or so, and I'm just using that 4 years as an example, and I'm going to return it back. Revert back means I'm going to return it back to the lessor at the end of the lease term. It's actually, in reality, the lessee promises to return not only the asset, the property, but also is sufficient cash to provide the lessor with the minimum combined value. Is the beauty of the world of lease that the lessor not only getting a return on the assets, but also a guaranteed value on the assets when you get it back. A cash payment would be expected as of the beginning of a lease only if the guaranteed amount exceed the estimated residual value of the asset. So let's say the lessor give the right of the assets to the lessee, and they expect that the assets will come back with a residual value, let's say, of $40,000. Then the lessee comes in the agreement and guaranteeing they're gonna return it with 45,000, guaranteeing 45,000. So the 40,000 was the residual value, and the 45,000 is the guaranteed residual value. There is a 5,000 in between, the difference in the value, and it's guaranteed of a cash payment in addition to the residual value that you're returning the cash with, the asset with. So if a cash payment under a lessee guaranteed EEEE, the lessee guarantee the residual value is predicted, we need to calculate the present value of that payment and is added to the present value of the periodic payment. I'm just going to remind you, remember when we calculated the present value of the minimum lease payment? Remember, we did actually add the guaranteed residual value, and we said if any. Here is the time of any. This is exactly what we learned, that I went back to the early slides. When I calculated the present value of the minimum lease payment, I said if I have a guaranteed residual value, everything would be present value. I'm adding that to the box of the minimum lease payment. So I have the periodic payment and I have the present value. Okay? From the lessor will include the expected cash payment as well as the residual value itself in the lease receivable, assuming the sale type of lease. So we're going to take an exercise. We're going to go over the different scenarios, how they calculated, and you find how simple that is. Uh, and I know, and I always say it's simple, but the time you add additional information in the topic, it actually make it much more comprehensive. So I don't want you to lose track. I want you to go uh, easily, smoothly through the materials with the sequence. As you go, we build it from just knowing what is lease, the agreement between lessee lessor, the provisions of the lease to make it finance, to default the lease to make it operating, to move on building additional payment, and now we coming to the residual value. Okay, so with that, just to understand what we were talking about, make sense of it, This exercise 1524 is about calculation of the annual lease payment. This is the residual value. So the exercise give you four independent situations, and they describe a finance lease in which annual lease payment are payable at the beginning, annuity due, of each year. The lessee is aware of the lessor implicit rate of return, so that means we're going to use the implicit rate. So we're going to treat each scenario here, each situation as different exercise. Just move this a little bit. The all independent, except the information that we got earlier that the beginning is the way that they're gonna treat every payment is gonna happen at the beginning. Okay, and the implicit rate. Now for each situation they ask us to determine the amount of the annual lease payment as calculated by the lessor, and then the amount of the lessee, the amount the lessee would record as a right of use assets and a lease liability. So what they're trying to tell you, how much would be calculated from the lessee and the lessor side when you have that. So we're starting with the first one. We have 4 years term. Actual return on lessor is 10%. This is the implicit rate. The fair value of the asset is 50, the cost is 50, and we know it's a finance type of lease. Here is the part that we really need to focus on, and this is the added information that we need to tackle the residual value. There was no residual value, and many times when you read an exercise that says and no residual value, those are the easiest, simplest exercises. But once you start to get information about there is a residual value, you're just going to make sure how much is the residual value, is it guaranteed or not, and if there's any cash payment. Okay, but with that, this is the simplest one. There was no residual value, no estimated, and no guaranteeing either. So from the lessor, you're going to take the amount to be recovered. You're going to take the fair value of 50,000, fair value of the assets, divided by the factor. And the factor is you're going to lease it for 4 years at 10% at the beginning, annuity due. I go to the table of the annuity due and find the factor. 4 years at 10% turns out to be 3.48685. Take the 50,000 divided by the factor, come up with the periodic payment. Simple. So that's from the lessor side. Lessee side, gonna take that periodic lease payment multiplied by the same factor because it's the other side of the coin. So take the periodic payment multiplied by the factor, come up with the right of use assets or the present value of the minimum lease payment, 50,000. There was no residual value to add, if any. Simple. So 50,000 divided by the factor give you the periodic payment. Take the periodic payment multiplied by the factor, give you the right of use assets or the present value of the asset. Okay, so that's scenario one. Scenario two. Scenario two, they said lease term is 7 years. Lessor 11%, the implicit rate. Fair value is 350. The cost is 350. Residual value, voila! For the first time I'm reading, there is a residual value of 50,000, but I'm not guaranteeing anything. Okay. So what would happen from the lessor's perspective? You're gonna take, and this is gonna become a formula now. You need to know this formula. The formula says you take the amount to be recovered, which is normally the fair value, 350. You're gonna deduct the present value of the residual value. Why? Because if the lessor is expecting to get the asset at the end of the lease term worth of a value, I should deduct this amount, present value of the residual, because I need to adjust the periodic payment. Why would I overwhelm the lessee with a periodic payment is greater? So actually, if there is a residual value, it should impact the periodic payment to make it less, because what I expect to get at the end will reduce the value of what I should be getting from your periodic payment, because at the end of the day, at the end of the term of the lease, you're gonna give it to me. It has some value to it. I'm not gonna be greedy and get, periodic payment with a high value and then also get the residual. No. So I'm gonna take the amount to be recovered, and it's become a formula now. So you always have to know the formula. It's amount to be recovered fair value minus the present value of the residual value. The residual value is 50. That's from the lessor side, multiplied by the factor. I give you a table 6-2. I'm going to remind you one more time. I'm going to go back to where I started. I'm going to give you exactly where I told you that. Remember I told you to go to the table? Only when I have a bargain or a guaranteed residual, I use 6-2. And voila, this is the time I have a residual value. I have to go and get the table 6-2. I come up with a factor. So let me go back to the question, please. So the formula says amount to be recovered fair value 350 minus the present value of the residual value. Where I get that factor from? The lease term is 7 years at 11%, right? That's the periodic payment. That's the periodic payment. But I also have the annuity, I'm sorry, not the annuity, the present value of the residual value or bargain purchase coming from that table. So I'm gonna go and pick up the rate 0.04166. Where I get that from? So you're gonna get that from the 7 years at 11% discount rate. You get the rate, you get the multiplied by the residual value 50,000, you get the present value. So your amount to be recovered minus the present value of the residual value 24. Whatever comes up, the amount to be recovered, you divide it over the same as we did before. So if I go back to number 1, so this one was without residual value. I come up with the periodic payment divided by the factor, and then I get the periodic payment. But remember that factor was, again, but that based on, it was the beginning, so that was the annuity due. Now coming in here, I have 2 rates to be used. The first rate, see that 1 star only? That 1 star only is the table 6 dash. Let me write it here so when you go back, so this is table 6-2. I get the first rate. Okay, it says present value. Did they write annuity due or ordinary? Because it's not. It's 6-2 is the time value of 1. Then whatever the difference is, I'll take that, and now I get the periodic payment by divided by the annuity due factor, which is the second 2 stars. And this is again 7 and 11. 7 is the years, 11 is the percentage of discount rate. Get the 62. So this is going to become the periodic payment. So what is unique between situation 1 and 2? Situation 1, there was no residual value. Situation 2 has a residual value, but it's not guaranteed by the lessee. Remember, guarantee, lessee. It's not guaranteed by the lessor, it's guaranteed by the lessee. The lessor gonna get their assets no matter what, but this time they get some value into it. So I have to reduce that periodic payment. I cannot uh, double dip. Get get the periodic payment, it's high value, right? So imagine me not taking the present value of the residual value. I'm taking the 350 divided by the rate. You will find out that you're going to pay periodic payment as higher from the lessee side, but I'm not doing that. I take out the present value of the residual value, come up with amount to be recovered, divided by the annuity due factor, come up with the periodic payment. The lessee will take that periodic payment because you don't know any other way. You will take the periodic payment, multiply by the factor of the annuity due 7 years by 11%. You come up with the 325,917, which is after the residual value is deducted. But you see here from the lessee side, you did not touch the residual value whatsoever at all. You took the periodic payment, whatever is given to you, dictated in the lease agreement for you to pay, multiplied by the factor to get the present value. Because in here, the residual value was estimated but never been guaranteed. So the lessee has nothing to do with that. It's from the lessor's side. You're the owner, and you wanted to have some residual value on your assets when you return it back. There is situation 3 and there is situation 4. I know I don't have them with me here now, but I can do it with you right now. It says situation 3, the lease term is 5 years. The lessor return rate is 9%. And the fair value of the asset 75,000. Let me see if I can enlarge it a little. 75,000. The lessor's cost is 45,000. Estimated is 7 and guaranteed 7. There's nothing different. I estimate and the guaranteed. So how I'm gonna do it? I'm just gonna tell you, and I would rather you to actually practice it, but I will show you how to do it. From the lessor's side, you have the amount to be recovered is 75,000 minus the residual value. So you will take the present value of 7. So you look for the table 6-2. So 75,000 minus the present value of the residual value, we will find a rate of 6.64993. So you will deduct an amount from the 75. So the amount to be recovered in here would be, after you take out the present value of the residual value, the amount to be recovered after you deducted that will be 7,450. You take the 7,450, this is all the lessor's side. You divide it over the rate. And the rate is what? 5 years at 9%. It's always happen at the beginning, as they said in that exercise. So I'm going to look for annuity due, 6-5 table. Come up with the factor, and the factor will be 4.23972. And then that give me a periodic payment of 16,617. Okay? But first, remember, I took the 75,000 minus the present value of that 7. And the present value of 7 is going to come up to 4,550. Take the 4,550 minus 75,000 equals 7,450. Divided by the factor, give you the periodic payment of 1667. Imagine how the lessee would do it. Your guaranteed amount is the same as the estimated residual values. There is no additional cash payment. So the lessor determined your periodic payment is 1667. All the lessee would do is to take that 1667 multiplied by the same rate, you come up with the same amount. It's kind of the opposite. So the lessee would be 16,617 multiplied by the same rate equals 7,450. You got the idea? So that's on situation 3. Let's see situation 4, how unique. Situation 4 is really, really unique, and that's what I really want to focus my time on. I have lease term of 8 years. The lessor return rate is 12%, and the fair value of the assets is 465, is the same as the cost, 465. The residual value estimated at 45,000, but you guaranteed as a lessee you're gonna pay 50,000. There's a 5,000 additional cash payment. So now let's see how we're gonna do it. Okay. So what we need to do, we're gonna say in situation 4, we have the following. We have the amount to be recovered, which is, as we said, is always the fair value. In our case, is $465,000, of course. I'm gonna take out the present value of the residual value, And that is actually, if I go to the residual value, I have a residual value of $45,000, and that would be 18,175. Professor, where you get that value from? That is the $45,000 multiplied by table 6-2 for the residual value or bargain purchase. I have a value of 1 and give me a factor of 0.40388. But I also need to take out the present value of excess guaranteed. Let me just put it in. Which is it's the 5,000. Where I get the 5,000 from? The 5,000 is the difference between 45,000 and 50,000. The residual, total residual value, they said 45, but the lessee guaranteed 50. That's a 5,000 difference. Where I get the 5,000 rate, it's the same rate, and that would be 2,019. Professor, where you get that value from? That's the 5,000 excess multiplied by the same rate, table 6-2 for the residual value, which is the 0.40388. Give you that. Now, when I run my math, that all 465 minus 18 minus the 2,000, I get 444,806. So that's from whose side? This is from the lessor, right? This is lessor. Am I done? No, you're not done. You know why? Because the lessor should take that and divide it by, so all the amount to be recovered. Now we need to divide it by the rate for annuity due, 8 years at 12%, and that will be divided by a rate of 5.56376. And somebody gonna ask me, where is that rate coming from? This is the present value of annuity due, 8 years, right, at 12%. This is coming from the question. I didn't make that up, right? So they said it's 8 years at 12%. So from the lessor, I really amount to be recovered, which is the fair value, book value here, fair value, pick to the fair value, minus the residual value, 45,000, multiplied by the rate from table 6-2. Only for 6-2, we only use it for residual value and bargain. Then I have 5,000 additional cash money also relate to the guarantee. Take the present value of that, divided all that difference, divided by the annuity due factor, which is table 6-5. That's from the lessor side. What do you think from the lessee? Here is the lessee and how it's unique. The lessee gonna take the present value of periodic lease payment, which is actually the 444 that you end up with, 806. And then I'm gonna add to it, remember, if any, the present value of the estimated of the guaranteed of the cash payment. Let me just take out the cash payment for for guaranteed residual value. GRV means guaranteed residual value. Is the 2019. That means my total present value equal to 446,825. I just put the line and I'm gonna call it here from lessee's side. So the lessee, the one when I told you about the schedule or the diagram earlier, I said you take the periodic lease payment, the minimum lease payment plus guaranteed residual value, if any, not the full residual value, only the additional cash payment of the guaranteed residual value, about the 5,000. So if you notice, this is, instead of me writing the whole thing 5,000 multiplied by the rate, I just picked up the amount and I just added. So the lessee will pick up the total amount. The 444, if you want to give a title to it, is the amount to be recovered through the periodic lease payment. I took that present value of the periodic lease payment and add to it the present value, which I already calculated, but I'm adding here. See here, I'm deducting. From the lessor, I have to reduce the periodic payment. I forgot to tell you the amount that you should be paying at the end as a lessor. So the amount that you should be paying at the end, not that, the amount the lessor, I'm sorry, the amount the lessor has to determine at the end, I have to write it down for you, 79,947. So if I take the amount of the fair value minus the residual present value minus the additional cash, in reality, if you add these two together, this is the full 50,000. See that? They give you the full guaranteed value is 50. 45 estimated residual and the 5 is the cash payment. At the end of the day, as if I took the present value of the 50,000, but I have to show it this way, the 45 and the additional cash. So would be the present value deducted from the amount of the fair value, come up with the periodic payment, the amount to be recovered for the periodic payment, divided by the annuity due rate, come up with the periodic payment of 79. The lessee, of course, gonna take that 79 multiplied by the same rate, but anyway, come up with the 44806. It's the same thing, but the opposite. 79 multiplied by the rate equal 444,806 plus the present value of the cash payment for the $5,000, only the $5,000, only the cash payment of $5,000. Okay. I just want to be clear to write of the $5,000 only. Okay. And just I'm moving the line down. So now let me minimize it so you have the whole lessee lessor for situation 4. Okay. Okay. So I would say for you guys to really have a good practice, just see the amount now from the lessee lessor, how it be different. So if the lessor is taking, if the lessor is preparing the amortization schedule, you have a different amount than the lessee amount. See that? The lessor has an amount different than the lessee amount. So when I prepare the amortization schedule, I don't have the same base. When I did the 4 million was the 4 million in the other exercise. In the two places it's the same, but here it's different. So just make sure when you prepare an amortization schedule, when you have two different bases, it will trigger two different numbers. um, I will assign a homework for you on the guaranteed residual value. I will post it on Blackboard as well, so you would know the homework on leases and when it's due. But it will be on that section. All right. Okay. Now, let's move on to another area. We're going to talk about another part from leases called purchase options. Remember when we talked about lease accounting, we talked about the minimum lease payment. We also talked about the additional amounts that we're going to pay, if any, if any, if any. So we talked about the guaranteed, if any, and that's the part that we just covered. Now we're going to talk about the purchase option. Uh, so, what is the purchase option? When we write the lease term, the lessee and the lessor try to come into an agreement. Sometimes in the beginning of the lease term, when the lessee and the lessor sit down and try to write the terms of the lease, they try to entice the lessee to purchase the assets at the end of the lease term. So I'm going to lease it for you for 4 years, for 2 years, and then I'm going to give you, a provision in the lease to tell you you have the right to purchase the asset at a value less than the fair value. So it's like, oh, that's a bargain, but it has to be written. That's why when I put the O, the W, I said the W for written bargain purchase, because I want to provide them with that, uh, uh, you know, I don't want to say privilege, but that option, if you will. I want to provide them with that option. So a purchase option is really, I'm giving the lessee the option to purchase the asset at a specified exercise price. And that should be reasonably certain that you, as a lessee, will exercise that option. Okay. So a purchase option is a provision of some lease contract that gives the lessee the option to purchase the lease asset during or at the end of the lease term at a specified exercise price. We should be certain about it, or reasonably certain about it. The accounting for the lease is affected in three ways. One, the lease is classified as a finance or a sale type of lease. So I cannot give them the purchase option in the operating. Two, both the lessee and the lessor would consider the exercise price of the option to be additional cash payment, okay, because you're purchasing really. Three, we assume the lease term ends on the date that the option is expected to be exercised, because if you in practice a purchase option, if it's really reasonable, it should extend. Really, you're gonna buy it, it's gonna be yours as a lessee. You're purchasing the assets at the lease term. That means you're not gonna return it back to the lessor. um, so the length of the lease term is limited to the time up to when the purchase actually happened. Once you started to purchase the asset, the lease ends, and then it becomes yours as a lessee. I'm going to add to these uh, three ways that should impact the lease. The right of use asset that is recognized by the lessee, because I'm dealing with it as a finance type of lease or a sale type of lease, I should amortize the asset. When I purchase the asset, I should amortize the asset over the economic useful life of the asset, because the lessee become the owner. If the lessor give the lessee the option to purchase the asset, then the lessee, when you get the asset, you should amortize the right of use assets to the longer term. To remind you with that diagram, taking you back to these things that have to make sense. Let me just remind you. When I said the O or the W, I have to depreciate or amortize over the asset life, the economic life, the useful life, they all the same. The longer life. Why? Because you're buying it or it's gonna transfer to you. So that's where we at. And another thing to remind you as well, when you do the present value of the minimum lease payment from the lessee side, see the bargain purchase, if any. So what I covered last time, I covered the guaranteed residual, if any. I added to the present value of the minimum lease payment. Also, what I'm gonna do from the lessee side, the present value, I'm gonna add the present value of the minimum lease payment, the bargain purchase, if any. Now I'm coming into this part, the bargain purchase, if any. Okay, so let me go back to the bargain purchase, if any. And we'll take some exercises about what we're saying to see how we're gonna enforce the materials of learning the bargain purchase. So in the bargain purchase, it says exercise 1528. It says calculation of annual lease payment purchase option. For each of the three independent situations below, determine the amount of the annual lease payment. Each describes a finance lease, as we said, in which annual lease payments are payable in the beginning of each year. What does beginning mean? Annuity or ordinary annuity? Annuity due or ordinary annuity, it would be beginning would be annuity due. I'm sorry, would be annuity due. Yes, annuity due. Ordinary annuity, which is at the end of each year, but when they say at the beginning, use the table 6-5. Each lease agreement contains an option. Let's read the option that permits the lessee to acquire the leased assets at an option price that is sufficiently, here's the language about the bargain, the price is sufficiently lower, that makes it a bargain, than the expected fair value of the exercise of the option appears reasonably certain. So in the beginning of the year, we're going to have some payments, but we also have an option to purchase the asset at a lower cost or a lower value than the fair value. That's the bargain piece. They give you three independent situations here, 1, 2, 3. And they said, we'll take the first one first. So the first scenario says we have a lease term of 5 years. The lessor return of the rate of return, which is the implicit rate, is 12%. The fair value is 60 and the cost is 50. Purchase option. Remember last time we're talking about residual value, but this time is the purchase. Exercise price is 10,000. Exercisable at the end of the year 5, means that the last year of the term. Reasonably certain says yes. Okay, now we're gonna learn how to actually uh, determine the value here, the periodic payment. So the amount to be recovered is always the fair value, and the fair value is given as 60,000 less. Remember, I'm here in the lessor area. I'm in the lessor. Okay, I'm in the lessor. Present value of the exercise price. The exercise price is 10,000, and we learn there is a specific table 6-2. We use it only when we have a bargain purchase or residual value. So I'm going to go to the table. The first star. The table is 6-2. I'm going to go to 5 years. This is what they gave me, 5 years for 12%. I get a factor of 0.56743. And I'm taking out that present value. I'm on the lessor side. I'm the lessor. 60,000 fair value minus the present value of the exercise, come up with the amount to be recovered through periodic lease payment, divided by the factor. from the table 6-5 because it's an annuity due. You take the annuity due, you go to the table, you will find the rate 4 zeros. Someone will ask me, so what is the difference between that rate and that rate? That rate is only specified for residual and for bargain 6-2. The annuity due that you learn, an ordinary annuity, the table 6-4 and 6-5, those are for your periodic payment. So to come up with the periodic payment, you take that value of 54 and divide it by the rate. You come up with the periodic payment of 13,456. This is from the lessor side. Okay, situation 2. 5 years, this time at 11%, not 12%. The fair value and the cost is 420. Exercise price is 50,000. Exercise at 5, reasonably certain. They said no. Okay. So what is the difference here? So the amount to be recovered will be the 420 fair value less the present value of exercise price, and we said 0. Why? Because it's not reasonably certain. So what makes the distinction between the first time we calculated out of the out of the fair value because it was certainly yes. So I'm going to take you back to situation 1 and show you that it was saying yes. That's why you factor it in your calculation. The second one you did not factor in situation 2. This is situation 2. And you did not factor it because it says no, it's not reasonably certain. It's not going to happen. So here is the amount to be recovered through the periodic payment divided by the rate, and the rate again 5 years at 11% at annuity due equal 102,378. Okay. There was another situation, situation 3, and I would love for you to practice situation 3. And situation 3 is similar to situation 1. Here is 4 years at 9%. Fair value is 185. Cost is 145. And the periodic, and the exercise price is 22,000. Exercise at the end of year 3, and it's yes. So you will start with the fair value minus the present value of the exercise price 22 multiplied by the rate, right? And then you get the rate. I'm just gonna say the rate will be 0.77218. You run the math, will be 185 minus 16,988. You come up with the amount to be recovered through the periodic payment, and then you divide it by the numbers of the and the present value of the annuity too. This time, the purchase option is reasonably certain to be exercised. The only thing that you should be careful with is using 3 years to get to the rate. It's 3 years at 9%. You're not going to use 4 years. Why? Because we said when the exercise happen, it will end the lease term and it will exercise the will start the exercise of the option. So that means when you do the search for the rate, you do it at 3 years at 9%, not 4 years. That's the only difference, but the same calculation, similar to situation 1, if you will. That's why I want you to do it, and for your own practice, the periodic payment should equal to 6894. The answer is it should end up to 6894, but I want you to try it on your own. But here's the answer. So the periodic payment will be 6894. Okay. Alrighty. So let's go to this is some information that you should be aware of, which I already covered in the beginning, but this is here some repetition. Non-lease component, I mentioned them before. Those should be separated than the lease payment. and those are like maintenance, taxation, insurance. Those are the, it should be dictated in the lease agreement who would pay it. So sometimes it's really paid directly or indirectly. Sometimes the lessee would pay it, but if you pay it, you have a separation between the periodic payment and the non-lease component, the maintenance, the other expenses. Okay, so here is an example to the non-lease component. Okay. This is exercise 1533 about the non-lease payment for lessor and the lessee. On January 1st, year 21, NRC Credit Corporation leased equipment to Brand Services under a finance sales type lease designed to earn NRC a 12% rate of return. So the NRC is the lessor. The leased equipment to, not all the other exercises were it from. The leased to Brand. The rate of return is 12%. And for providing a long-term financing, the lease agreement provide the following or specify the following: 10 annual payment of 55,000 beginning January 2022. I think you all now are pro of learning what is beginning, what is ending. The beginning of the lease and each of December 31st thereafter through 2029. They can do that. They can pay some payments early years in the beginning and then they switch to ending, that they can do that. B, the estimated useful life of the lease equipment is 10 years with no residual value. Wow! For the first time now we pay attention to what was estimated residual value without having, to bother with the calculation of the present value of the residual value. So the easiest way when you have any questions without no residual value, make it easier. The cost to NRC was 316 for 12. C, the lease qualify as a finance type lease from the lessee and sale type lease from the lessor. D, a 10-year service agreement with Quality Maintenance Corporation was negotiated to provide maintenance of the equipment as required, payment of 5,000 per year as specified. So if you notice, there should be a periodic payment, but there is additional uh, the $5,000. So what we need to do is we always need to separate. We need to exclude the 5,000 from the 55. So technically the periodic payment is $50,000. So anytime, so I'm going to go back to the slides just to emphasize one part. Lessee records a right of use assets and lease liability for the present value of the lease payment, excluding the non-lease component. I didn't want to read it then because I want to pinpoint where is that would make sense. So where it makes sense is while you read the question, if you find there is an annual payment, periodic payment, and there's also the payment of the maintenance or taxes or any non-lease component, make sure you separate the two. Okay. Also, is going to happen at the beginning. There was NRC to pay this cost as incurred, but lease payment reflected this expenditure. So someone will ask me, Professor, how would I know the 55,000 inclusive of the 5,000 or not? They would tell you. So here they would tell you there were part of that reflected that the 55 include the 5. So what I need to do is to separate it. But if they give it to you separately, so you don't need to exclude what has been excluded. So if I give you the periodic payment is 50 separate, and then I tell you the maintenance get to pay separately, and the 5,000 is separated from the periodic payment, then you don't have to exclude the 5,000 from the 50 again. It's already been excluded. In this case, they would tell you the 55,000 was the annual payment, and then but the lease payment reflected this expenditure. This sentence, let me highlight this sentence for you. This sentence is the one that caused me actually to separate the 5,000 from excluded from the 55,000. That's why I went back to read that note for you. And a partial amortization schedule was prepared for you already from the Lasila source side. So they said, here is the whole amount of the assets, the present value of 316 for 12 starting point, because it's the beginning. So the first year is not going to be lapse between 1 1, right? So there is no interest calculation. The 50,000 all will be the reduction of balance. Take the 50 minus 316 for 12 equal 266. 266 multiplied by 12%. Don't get a habit of write 10% because not every question has 10%. 12%. 31 minus the 50 give you the remaining of 18,031. 18,031 from 266 for 12 equal to 48,381, and so on and so forth. Again, this is a sub section of the report. It doesn't have the full report. They give you just a partial. And I did that for one of the exercises earlier. I just prepared one for you. Now they ask you to prepare the journal entry between lessee lessor. And it's a repetition of what we have. The only difference that you will notice, and as we go through, it's just the separation of the 55 between 50,000 periodic payment and the maintenance. So from the lessee, right of use assets is given present value to lease payable. I don't need to prepare all that. If you want to prepare it again, that's fine. Coming to the part where we pay the payment, the periodic payment is 50 and the maintenance, see how they separate it, but the full payment is 55,000. That's the only difference. The rest are the same. Nothing really to change. From the lessor, lease receivable, gonna get the full amount, get rid of the equipment, remove the equipment. Cash, 55, a piece of it to maintenance and a piece of it to receivable. In the story. And the next year, we're gonna start to see the interest. So will be a piece interest and a piece the remaining balance and the maintenance expense separate. You see how the maintenance expense is separated from the periodic payment, and the periodic payment, total periodic payment would be the minimum lease payment and the maintenance, but two separate. But I'm gonna pay the 55,000 anyway. The amortization expense, are going to take the 316 and divide it by 10 years, get to the right of use assets, 31,641. And we're going to have from the lessor side, going to take the 31 expense, going to be interest revenue, and the payable become receivable. The maintenance expense, I'm going to receive it as well. So in return, I'm going to take the full 55. So this is the whole section here will be the opposite from the lessor side. Let's see lessor. Okay. Uh, what is coming here is just a theory. There's no calculation need to be done here. We're talking about what if we come to the point that we need to remeasure the lease agreement. For example, LLC had no significant economic incentive as of the beginning of the 6 year to exercise a 2 year extension. Let's say I have a 6 year worth of a lease term, and I have the right to exercise. Sometimes during the lease term, I can just come back and reevaluate the lease term. See, let's say I'm on the third year, come in to see if any significant improvement happened to the lease. Anything is not reasonably certain, become reasonably certain. So this is just a theory that sometimes, and this is real, that happens in real life lease terms. Sometimes after the lease agreement happened, on the fifth year, the third year, they come in and say, you know what, we'll probably changing some provision of the lease that might change the liability, increase it, decrease it. We have additional things that happen. There could be some modification to the lease term that we need to reassess or remeasure where we at with the lease. That's it. That's just a theory. But in reality, that happens a lot. That happens a lot. That they remeasure again the lease and rework the lease terms again. Another theory here, conceptually, lease modification. The lessee and the lessor may agree to modify the lease term. uh, maybe they change the right of use assets, maybe they have more or have less. Again, this is in the theory of changing the lease term, the agreement, that could happen as well. Again, this is just a theory, no calculation here. Another theory, a termination penalty. If it happened that it ever they need to terminate and they put in the lease agreement that there will be a penalty. We learned in the beginning of the slides, we learned when we calculated the minimum lease payment, we could have a guarantee, if any, we add that to it. If we have a residual, we add to it. And if you have penalty, that's why I said it's in the theory, but you wouldn't see it in the question. But in reality, these penalties exist, and in the termination that happen because the premise about having a lease is to have it enforceable and not out of nowhere you someone of the lessee or the lessor come in and says, I don't like the terms, let's cancel the lease, let's terminate the lease, unless there's disagreement somehow, somewhere of the deliverables and executing the lease. But they have to put these penalties terms in the lease agreement just to uh, preserve the right for the lessee and the lessor. But if it happens, these penalty also has to be additional cash payment that need to be added to the lease payment. Okay. Another theory. Conceptually, we have to know, and this is reality that happens a lot and should happen, and it's actually a requirement of GAAP, that any um, lease agreement should have all the lease disclosure from the lessee and the lessor, the cash flow, the interest rate, the payment, the who's responsible for what, when, where, is there is a guaranteed payment, if there's a bargain person, all the terminologies that we talked about, we they talking about extensive amount of disclosure, and this was required by GAAP. Okay. Now we're going to talk about part in the appendix in the chapter. Uh, the chapter has an appendix that is very unique. It's talking about an agreement, a specific type of agreement. It's very specialized called sale leaseback. So let's envision this. So I'm going to take you back to the first slide that I ever introduced to you here. We talked about a relationship between lessor and the lessee. The lessor was the owner of the assets or the property who's leasing it to the lessee, and in return, the lessee pay periodic payment. So we understand the two stakeholders here, the lessee and the lessor. The lessor, always we call it the owner, the lessee wears the hat, this is the user. In the agreement that I'm going to introduce to you, sale and leaseback. So the lessor will sell it, not to give you the right of use asset to the lessee. We're actually going to sell it. And then at the same time, I'm going to lease it back. So I want you to envision these two arrows in this relationship. Arrow going to the lessor and arrow coming here. But I'm not going to give them the right of use assets. I'm going to change that. I'm going to give them, I'm going to sell it. I'm going to sell that asset as a lessor. And then I'm going to lease it back from them. Wait a minute. So why I have a piece of property, an asset, an equipment, I will get rid of it. I will sell it, then lease it back. So it's mine in the first place. Why would I do that? This is very highly tested in the CPA exam. They love the sale lease back. I guess because this is the relationship which is very unique. The lessee lessor switch hat. So the lessor, in a state of becoming the owner, the lessor become really taking the lead. We will be the lessee, if you will. because we're switching hat. Because once I sell my assets, I'm not the owner anymore. I'm gonna sell the assets and I'm gonna get cash back for it. So I got the cash, but I still need my assets, so I lease it back. It's very, very unique, and I'm gonna show you why they do that, why they sell it, and if they are the owner in the first place, why they sell it, but then they get it back, they lease it back. I would say yes. The owner of an asset sells it, and immediately, here is the key word. So what if I sold it today, but a year from now thinking about, I'm gonna lease it? No, 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 that transaction happened immediately. You see that the 2 hours that I draw earlier, or a minute ago, I draw an arrow going to sell it, an arrow coming back immediately. So I sell it and lease it back from the owner, the new owner. Two things that happen in the sale leaseback transaction. The seller is the lessee. Why? Remember, the seller was the lessor, right? The seller, the owner, was the lessor. Now you become the lessee. You receive cash from the sale, and then you pay the periodic payment for the lease. So it's kind of like two transactions taking place. First is sale, and I get cash back from the sale. And then there's the lease, and any lease you pay the periodic payment. So one time you get cash, and then you pay for your periodic payment. Very unique. So why we do that? The reason is we effectively refinance at a lower rate. So when you sell it and lease it back, this is the sale here is like you find refinancing for yourself, and also to generate cash. Okay. Sale lease back take two forms, or two ways, if you will. So it's either we treat it as a sale leaseback approach, or we treat it as a finance. When each one would happen in the sale leaseback, in the sale leaseback is only, and instead of reading this, I'm gonna show you when. The sale leaseback approach is allowed only if the leaseback qualifies an operating lease. Remember, there's two transactions happen at the same time. I'm selling, so I'm getting rid of the asset and getting the cash. That's one. And then I'm leasing it back. Well, someone will ask me, so Professor, when you lease something, you already classified the leases as finance lease or operating lease. The only time the sale leaseback will be considered to be a sale leaseback approach if it's an operating lease when you lease it back. Or you consider it as a finance, so you treat it as a loan. So the sale leaseback approach record the sale of the assets, including applicable gain or loss, then record the lease for the leaseback portion in accordance with the standard lease guidance, but as an operating lease. So I'm gonna show you two examples for the same information, but one time they treat it as an operating lease, and then another one they will treat it as a finance arrangement, as a loan. They treat it as a loan. So they said if you treat it as a finance, not finance lease, they treat it as a finance arrangement. View the arrangement not as a sale, but as a loan by the lessor to the lessee for the sale price. The asset remain on the lessee's books, and the lease back is accounting for as a debt. It sounds overwhelming here, but in reality, you will see how simple the application is. So let's jump into the exercise. Exercise, we're going to take actually two exercises, 1541 and 1540. Okay, and I will show you the difference between the two. Let's start with 1541 first. That's the sale leaseback If the lease actually been treated as an operating lease, we consider it as a sale. To raise operating fund, this is exercise 1541. To raise operating funds, National Distribution Center sold its office building to an insurance company on January 1st, year 21 for $800,000. So here's the sale and then lease it immediately. That's the key. So that's what sale, lease back, and immediately lease the building back. The operating lease, they already told me it's an operating, so that qualify as the sale approach. This operating lease is for the final 12 years of the building, estimated 20-year remaining useful life. The building has a fair value of 800,000 and a book value of 650. Its original cost was 1 million. So I have a fair value of 800 and a book value of 650 and the original cost a million. So that's the carrying amount now, right? The rental payment of 100,000 are payable to the insurance company each December 31st. The lease has an implicit rate of 9. Now, they ask you to prepare the entries for the National Distribution Center. Who is the National? National sold its office building and then leased it back, right? So we need to record the sale and then the lease back December 31st to record the necessary adjustments. So let's do the sale first. Any sale, any sale, you got cash for 800 and they actually give you the cash. You, the building has a fair value of 800, so you got the cash is given 800. You get rid of the building. The building has $1 million, so 800, 1 million. What's the accumulated depreciation? If I'm getting rid of the building, I'm getting rid of the accumulated depreciation. How would I know the difference? The 350 is the million minus the 650, the book value now. That means I accumulated depreciation of 350. So that's the million minus the 650. What is the gain? The gain is the difference between the fair value and the book value. So the 800 minus 650 equal 150. So now we'll formulate the whole entry. Debit cash for the sale amount, fair value. Accumulated depreciation difference between the cost and the book value. The building, the original cost of a million, and the gain is the difference 150. Could be a plug number if you want to say so, or it's actually the 800 minus the 650. That's the sale. So I told you that transaction, it's going to be in two pieces. The sale first. So that first one is sale. The second one is lease back. So the right of use assets, how would I get that number from? Remember when they said the rental payment is 100? Yes. Periodic payment? Yes. 9%? Yes. For how many years? For how many years? They said the operating lease is for the final 12 years. Okay? So I go to the table. But this one is ordinary annuity. Why ordinary annuity? Because they said the payment gonna be at each December 31st. By the way, don't be tricked by that because you always have to know when is the beginning, when is the ending. Some companies, for some exercises they give you, is gonna be the payment gonna happen beginning December 31st. So a student who's not focused that much will think that should I take the ordinary annuity or annuity due? Anytime they said beginning, it should be ordinary annuity. So the January and December, this is just the guidance, but you have to know when is the annuity. It could be beginning December 31st, so it's still beginning. This one gonna happen payable at the end, which is December 31st. So it's the ordinary annuity, 12 years at 9%, give you that rate from the table. That is the lease payment. So the first thing is that they want you in January to record the sale and lease back. So first for a sale and lease back. That's just at January. Why I'm doing this? Because this has happened immediately. So these two entries are simultaneously taking place. Then what is the number two? Is to actually do the interest, and we learn it's like you prepare a small amortization schedule, or you can do the following: interest expense 716 because it happened at the end, so you the time lapses, you can calculate the interest right away. The remaining is the lease payable, and the total amount is $100,000. Okay, imagine there is an small amortization schedule. You don't have to do the amortization schedule. It's a small payment. But at the December 31st, as long as the interest happen taking place, also the amortization should take place. And because we said any sale leaseback should be treated as an operating lease, remember when I said the operating lease have a unique amortization to is the plug number? So they take the total periodic payment minus the interest. It give you the amortization, the plug number, the difference between the two. The periodic payment, 100,000 minus the interest, give you the amortization amount. So the amortization expense, 35,553, to the right of use asset, 35,553. Why? Because that we treat it as an operating lease. This is the only time you see it this way. When I do exercise for the sale leaseback treated as a finance arrangement, as a loan, you will find totally different arrangement here. Okay, so with that, we're going on to the next exercise for the sale leaseback. It's the same information. To raise operating fund, signal aviation. No, we're changing the, I'm sorry, we're changing the exercise. To raise operating funds, Signal Aviation sold an airplane on January 1st, year 21 to finance company, to a finance company for 770. Signal immediately leased the plane back. See the transaction, very unique, for 13-year period, at which time ownership of the airplane will transfer to Signal. Remember, it's a finance. There's a transfer of ownership. That, remember the criteria: ownership transfer. They will transfer ownership, so that's automatically a finance type of lease. If it's an operating type of lease, I'm going to treat it the same as I just finished exercise 41. The airplane has a fair value of 800. Its cost to the in its books were 600, and useful life is estimated to be 15 years. The lease requires Signal to make payment of 102 771 to finance, or to the finance company rather, each January 1st. Signal depreciates assets on a straight line basis. The lease was or has an implicit rate of 11%. We need to prepare the journal entries, one as of January and as of December. Just remember here, because it's a finance type of lease, how would I know? There is a transfer of ownership, takes it automatically to become a finance. Once you have that finance arrangement, you treat it as a loan. First thing first, the present value of the periodic payment. I have 102,770 7071 multiplied by the rate. Annuity due happened at the beginning, 13 years at 11%. Where I get this information? They tell me here, 13 years to lease it back. Leased it for 13. That's the lease term. Implicit rate is 11%. And the payment, the periodic payment, is 102. So I took the 102,771, went to the payment. It happened at the beginning, each January 1st. Take that 13 years, annuity due at 11%. I come up with the rate. That give me the periodic payment. Look how I treat it. As of January, I didn't say right of use assets, none of that. Cash, notes payable. Notes payable to cash. The cash here is the given 770, the full amount, to notes payable. And then I'm going to start to pay periodically 102,771 as of December. The interest, will be the 770 minus the first periodic because it happened at the beginning. So that 11%, I get the interest amount. Again, imagine a small amortization schedule. So this calculation should be simple now to interest payable. I'm still the owner. I'm going to depreciate expense to accumulated depreciation, the full book value divided by 15 years. So every year I will have notes payable to cash, notes payable to cash, for all the periodic payment for 13 years. They said the airplane is depreciated over its remaining useful life rather than the leased loan term because there is no sale or lease. The title remained with the lessee. Remember, you sell it and lease it back. When you leased it back, right, you leased it back, you take the full cost, the book value, divided by the 15 years. Okay, one more time. This time, you need to test the sale leaseback. And by the way, someone said, so why would you calculate the 770 if the 770 was given? Sometimes they do give it, sometimes they don't. But this is to prove to you that the amount that we're given, it was the right amount, the 770. So to recap what we said about the sale leaseback, we're switching hats between the lessee and the lessor. The lessor is the owner of the asset. We'll sell it. It's good. In the normal lease term, you give the right to use the assets. Now you actually getting rid of the whole asset. So you sold it. You get the cash because you're selling an asset and get rid of the asset. Then you lease it back immediately. That lease back should be characterized based on the criteria of the lease. It's either an operating lease or a finance type of lease. If it's an operating lease, you treat the sale lease back the sale lease back as we did here, just as a reminder. You actually got the cash, got rid of the asset, calculate your gain or loss. And then when you lease it back, you got the right of use asset. You got to treat it as an operating. So in the operating, temporarily operating, right of use asset to lease payable. The distinction, how you see how it's operating, is the way you amortize it. Because the amortization under operating lease is a plug number between the periodic payment and the interest, which in reality, this 35 equal the lease payable, right? But it's a plug number. That's if you treat the sale lease back as an operating lease. If you treat it as a finance type of lease, so the sale would take place, but you're going to treat it as a loan. Cash to notes payable. You still have the assets with you. Notes payable to cash, the periodic payment. And here is the difference. See how I did the amortization under the operating lease as a plug number? Here is the full amount as if you're still the owner, so the depreciation, the total cost divided by the years, the useful life of the asset. Not the lease term. Remember, you're still the owner, so we treated all the full 15 because you leased it for 13, but the full asset life is 15 years. Okay? Take your time to really go over the transaction of the sale leaseback, how the sale happened, and immediately take it back. And when you take a lease back, you have to distinguish between it's either operating lease, you treat the sale lease back as operating, and you record right of use asset, and then you recorded the expense at December 31st and the amortization as a plug number. If you're gonna treat the sale and lease back as a finance type of lease, and the distinction here they give you, there is an asset transfer, or it could be any criteria. Remember the criteria that we learned how to make it a finance type of lease. Then you use it as a loan, cash to notes payable, and then you pay the periodic payment as a notes payable to cash. And then at the end of any year, you always do the two things, the interest and the depreciation. Coming to almost the grand finale, those are just a theory. Also, those are conceptual, subject to question. Um, at the beginning of the lease, when the lessee and the lessor get together into an agreement, sometimes they incur some cost. Um, so these costs need to be accounted for. What are these costs and who would account it for it, and how? We call them the initial direct cost. So those are costs associated directly with consummating or executing a lease, essential to execute that lease, would not have been incurred if the lease did not take place. That makes sense. So what would happen? In the beginning of the lease, I need a lawyer to write the lease term, so I pay legal fees. Commission to get the person that, reliable credit and so on and so forth, to get the client that will have the lease with. Prepare and processing the lease document. This is all considered a direct cost, and it will never incur these costs unless the lease actually takes place and get to be executed. Okay. Now, how we treat these type of costs. Remember, we have different type of leases. So they said the lessor, the owner. This has nothing to do with the sale lease back. This is a different topic. Okay. These initial direct costs for the lessor account for the initial direct costs incurred. It depends on the classification of the lease. In a sale type of lease, that have a selling profit, what would you do? The accounting treatment is you expense it in the period when the sale take place. So if it's a sale type of lease with a profit, you treat it as an expense. I deal with the direct cost as an expense. Okay. If the type of a lease is a sale type of lease with no profit, I will take all these initial direct costs and defer it, postpone it, and expense it over the lease term. So I'm not going to expense it right away at the beginning of the lease. No, I'm going to defer it, and every year of the lease will pick up a little bit of it. I'm going to defer it and amortize it over the lease term. I'm not going to expense it right away. So there are different type of leases for the initial direct cost. If it's a sale type with profit, expense it right away at the beginning. If it's a sale type with no selling profit, you defer it and amortize it over, expense it over the lease term. What if it's an operating lease? If it's an operating lease, you take these direct costs and defer it and amortize it over the lease term. And they normally, as they say here, they use the straight line basis. Okay, so let's say we have initial direct cost of $10,000, legal fees and stuff like that. I'll take that, and it depends on the type of the lease. It would determine how will I reduce. It's either expense it directly at the minute, 10,000 expense to cash and get rid of, or take the 10,000 and defer it. So if I lease it for 5 years, so 10,000, defer it, take the 10,000 divided by 5 years term, and every year we'll take 2,000 and record it for it. That's the only difference. Another topic, and again, this is just a theory, advance payment, prepaid. What would you do with the prepaid cost? Those are in a finance type of lease is different than the operating lease. If it's a finance type of lease, those are included with the other payment, and it will be part of the present value of the right of use assets to lease liability. If it's an operating lease, they are recorded as rent revenue, deferred rent revenue. Okay. If there is an advance payment, again, there's no calculation. This is just in the theory. What if I have leasehold improvement? Sometimes I have a lease that is started, and then they start to do improvement on the asset or the property. What would I do with it? It might change the life of the asset, the useful life. So make sure this lease improvement is amortized or depreciated over the useful life of the lease. I'm sorry, the useful life to the lessee. Okay. And with that, we are done with lease accounting from the lessee and the lessor and the different type of leases. And to recap from the beginning, just to let you know, we went over chapter 15, the leases. We went over the relationship between lessee lessor. We learned that we could have an installment. We could have flexibility for the cost. We could have it to be financed. We could have tax advantage because of the depreciation. We learned the lessee lessor relationship, finance type of lease versus sale type of lease, or operating. We learned the criteria, the five criteria, the O, the W, the N, the S. We'll learn how to calculate the 90% and the 75%. Um, I'm gonna try to enlarge it a little. We learned how to calculate the percentage value of the minimum lease payment, and we took the minimum rental payment, and then for every topic that we add back to the minimum lease, we learned the guaranteed residual value. We learned the bargain purchase. We learned in the theory just the last part for penalty. We learned the non-lease payment. We'll get an exercise about how to have 55,000 and 5,000 included, and then we separated. We excluded that. We learned the discount rate implicit from the lessor. If it's known, will be used. And if it's not known, we're going to use the incremental from the lessee. So hopefully you still remember that. We learned the tables. The beginning, we used the annuity due, 60-5. We learned the ending. The ordinary annuity, we use 6-4. We learned how to do the depreciation or amortization over what period of time. It's either the asset life or the least life based on is the O, the W, the N, the S. We took some exercises that we went over in class. We covered exercise 15.1. We also covered exercise 15.2. We learned how to prepare the amortization schedule from the lessee and lessor side, especially if we have the same amount. If you start to have different amount due to the fact that you have a guaranteed residual value, the starting point will be different from the lessee lessor. That will trigger the once you start with a different amount, it will change the dynamic of the schedule because the amount that you end up to be interest and remaining, it will be different, but the bottom line is whatever the amount that you start with should end up with a zero. Any differences, few dollars, tuck it in the interest to come up with the dollar figure. We'll learn how to do the journal entries from the lessee lessor side, and especially on the exercise 15.6 and 15.7, we took the same exercise, same information, one time prepared from the lessee, one time from the lessor. We learn how to do the amortization schedule one more time. We learn the journal entries on both sides. Just as a reminder, we did the right of use asset to lease payable, and we got the difference here. We record the receivable, got rid of the equipment on the books only, and then we calculated the interest. We calculated the amortization expense. There was no depreciation on the lessor's side if it's a finance type of lease versus sale type of lease. We learned the sale type of lease with selling profit, that we learn how to record an entry between lease receivable and cost of goods sold, recording the revenues and getting rid of the equipment. We learned the operating lease from lessee lessor's side, and we learned that the amortization is a plug number between the periodic payment minus the interest. We took an exercise, actually two of them, 13 and 14, same operating lease. One time is from lessee's perspective, another time from the lessor's perspective. And I showed you how to do the recording of the journal entries and how we record here. Instead of the receivable, we recorded the deferred revenue. And here is the amortization is the plug number versus the depreciation on the full time of the useful life rather of the assets. We learned that the short-term lease that is 12 months or less, that is considered to be a periodic payment, is very straightforward. This is just uh, lease expense to cash, lease expense to cash from lessor side, from lessee side expense, from lessor side will be cash to lease revenue. It's just consistently take that periodic payment. It's really not much for that. Um, Big ticket item was the residual value that we learned how it's going to change the periodic payment and it's how it's going to be treated between lessee and lessor, especially if the guaranteed residual value have additional cash payment that is guaranteed by the lessee. We took these situations, the fourth situation in exercise 1524, if the residual value was never been recorded because there was no residual value, or if there is a residual value, how is going to get impacted the lessee or the lessor? How is the if the estimated is guaranteed with the same amount, or there's estimated and guaranteed with over with the cash receipt with a cash payment of 5,000. And I did all the situation. I lifted three, just give you the information for three similar to uh, what we covered for one in particular, especially. But just keep in mind the estimated residual value that you need to account for. Then I covered another big ticket item was the purchase options that would be granted at the inception of the lease to entice the lessee to purchase the asset on a lower market price than the fair market value. We took also these situation under exercise 1528 to show how you calculate the bargain, and the only difference is learn if it's reasonably certain or not, and also how it's going to impact your depreciation. It's also the depreciation going to be over the useful life because you're buying the assets. Excuse me. So we learned all these situations, and we covered also the non-lease payment if you have something that need to be excluded. If it was included in the periodic lease payment, if it was separated, that's fine. And we took an exercise to that. Um, and I showed you how the payment was reflected. The 5,000 was part of it. That's why we separated the 55 to 50,000 and the 5,000 for the payment. I showed you it's the same, everything as we learned, right of use assets and everything, but we separated the maintenance piece of the 5,000. Gonna get paid no matter what, but we separated that from the periodic payment. We discussed some conceptual items such as reassessing if anything got changed, if there is a lease modification happen, if there is a termination of the lease and there is a lease penalty, lease agreements, all the parts of the agreements need to be actually disclosed for GAAP perspective. And then we learn in Appendix 15 the sale type of lease of sale leaseback arrangement if it happens, the sale, and you immediately lease it back, it's either operating lease or finance lease. If it's operating, I showed you how you treat the operating in one exercise and how you treat it if it's a finance. If it's a sale, and then the operating come right of use assets and do the amortization as you did the operating. And if it's a finance, you're going to treat it as a loan. You're going to record the cash to notes payable, and then you have the periodic payment. Remember, you're still the owner, so you're going to depreciate it on the full uh, life of the assets. Then also we discussed the initial direct cost that you incur as a lessor in the beginning of the lease term, how you're going to treat it if it's a sale type of lease, you expense it right away. If it's a sale, uh, especially if it's a sale with profit, is without profit or operating, you defer it and you amortize it over the lease term. How you're gonna treat if you have any advance payment, it will add that to the right of use assets. If you have any leasehold improvement that could expand the life of your assets, so you amortize it or you depreciate it over the new useful life. Okay, with that, that is the end of all the lease chapter. Hope you guys learn it. And if you have any questions, let me know. I will assign the homework I will send you an email and also post it on Blackboard to tell you what is the requirement, where you post it, and all the details about it, and the grade for it, and when it's due. I wish you all the best and see you in future setting. Thank you so much and have a great day. Bye bye.